Karen, and thank you everyone for being here today. I want to also thank Innovest, Sherman and Howard Taft, and Ide Bailey. And before I introduce our first session, I want to just give a quick overview as to who each of us are from each of these companies. So Innovest is an independent investment consultant with assets of nearly 48 billion, dedicated to supporting nonprofit organizations with their endowments, foundations, operating reserves, and retirement plans. Through our specialized nonprofit expertise, experienced team, custom portfolio solutions, fiduciary guidance, and uncommon service, Innovest is invested in your mission. We also have Sherman and Howard and Taft here with us today. Sherman and Howard's nonprofit team serves a wide range of organizations, helping to shape the future in the United States and around the world. Their clients include faith-based organizations, educational institutions, charitable organizations, social welfare entities, healthcare organizations, private foundations and philanthropists, corporate foundations, and amateur sports organizations. On January 1st, Sherman and Howard will be merging with the Taft Law Firm, resulting in a national firm with over 1,000 attorneys, offering expanded depth and expertise for our nonprofit clients. And then finally, we are partnering with Ide Bailey today. Ide Bailey is a top 20 business advisory and accounting firm who works with the entire spectrum of nonprofit entities to address not only their financial issues, but also their business and operational issues as well. With more than 50 offices in the United States, the nonprofit sector represents one of the top 5 industries served within the firm, helping nearly 3,600 nonprofit clients. So we come to you today with a wealth of knowledge, and we hope to help each one of your organizations with the information that we're presenting today. Our first presenter is Christian O'Dwyer. He is with Innovest. Christian is a principal and consultant at Innovest, specializing in investment strategies and financial planning for endowments, foundations, nonprofit operating pools and reserves, and families. Christian will be speaking today on the 2024 economic update. So with that, I'm going to turn it over to Christian.
Great. Thank you, Sarah. Well, thanks everyone for joining this morning. So as Sarah mentioned, just a quick economic update, basically looking at current conditions, where we've been, where we're going, and the implications for nonprofit institutions. So thank you all for joining. Again, my name is Christian O'Dwyer. I'm a partner here at Innovest, and I joined the industry in 2008, and have worked in Denver and Chicago, started my career on the Chicago Board of Trade, and have been started at Innovest in 2014. I've spent time at UBS and the Bank of Oklahoma as well. Personally, I'm married with 3 children at home. So great to be with you all, and thanks again for joining. So quick agenda of what we plan on covering today. So first of all, economic outlook and current market conditions. Then we'll look at investment implications, some practical takeaways for portfolios and portfolio construction, and then considerations specifically for nonprofit organizations and portfolios. So getting started on the economic outlook and capital markets review. We just wrapped up an election. We're about to close the book here on 2024, and we'll kind of start by looking back and thinking about where we've been before we look at where we're going. So you think back to really the last 4 years, starting in 2020, and the global pandemic, the COVID-19 pandemic, really kicked off a series of economic events and cultural events, I would say too, that have really shaped the last 4 years that have been somewhat of a roller coaster. Economically, the implication was a massive spike in unemployment. So in this chart, you look at really if you think back to the 2008 period, as shown here, the global financial crisis and the banking crisis, we started 2007 sub 5% unemployment. We ramped up to about 10% in the U.S. This light blue line is the Eurozone, and Japan in the light blue line. We enacted sort of economic stimulus coming out of the global financial crisis. That served to bring the unemployment rate steadily down all the way on a fairly consistent basis all the way to the spring of 2020, where the unemployment rate spiked to 15%. So especially in the context of the global financial crisis, it really puts in perspective exactly how severe the layoffs were from the pandemic. So much shorter lived, we would say, and the data would say, given the amount of stimulus that was put into the economy and the recovery from vaccinations from the pandemic, a very low retreat to unemployment that actually started ticking back up this year. So how did we really get there? Well, the Fed really tried to counteract this global recession, and they did that by first lowering interest rates and also increasing the money supply. So again, if you look at more historical periods, so each of these bars represents a recession, an economic recession in history. So here's that 2008 period, and recessions tend to be counteracted by central banks with increased monetary supply. This serves to increase borrowing. Businesses have easier access to capital. They can take on capital projects. They hire, and so that serves to counteract those recessions. So the percentage change in money supply, though, generally around 5 to 10% of an increase. From COVID, however, we increased the money supply up over 25%. Again, just showing the drastic nature of the stimulus that was enacted following the pandemic. Inflation started to move higher fairly quickly, and the money supply came back in. And so we'll talk a little bit more about that and the implications of that. So what happened? So we did avert really a very long and severe global recession from the pandemic, despite that spike in unemployment. But one of the side effects was that given all the stimulus that was put into the economy, the global recession was averted, but inflation spiked. So as we were running in that 2018 through 2020 period on a global basis, so the U.S. is here in blue. Inflation was running right about target, I would say, at about 2% on a global spectrum. Japan lower, the Euro area slightly lower, United Kingdom's here and Canada also represented. But pretty soon, I would say after the stimulus measures, starting at really the beginning of 2021, inflation started to climb higher. We peaked in the summer of 2022 with the U.S. inflation of over 9%. That was higher in the Euro area, higher in the UK. And then obviously the Federal Reserve started this path of rising interest rates in an effort to bring inflation back down. So inflation is measured as a year-over-year percentage change. So these lines represent prices being nominally higher on a year-over-year percentage change relative to the prior year. So prices in the summer of 2022 were 9% higher in the U.S. Than they were the prior year. So the response to higher inflation, so obviously prices rising by 9% a year is not economically sustainable in the eyes of the Federal Reserve and others. So where we went, so the Federal Reserve had the ability to set the borrowing rate at which banks lend to each other on an overnight basis, which is the federal funds target rate. So that's this dark blue line. The China's here, Bank of England is in red, and the European Central Bank in light blue. Bank of Japan here at the bottom. So prior to the pandemic, prior to 2020, Federal Reserve target was right at 2%, and that had risen off of zero post global financial crisis. So they responded by slashing rates to zero in response to the pandemic. So we ran from 2020 really to the start of 2022 at a zero interest rate policy, and then started the subsequent. So as inflation moved higher, the response to inflation is sort of the opposite of what you do in that 2008 or 2020 period, where you're trying to increase stimulus and increase borrowing. You're doing the opposite. They're trying to restrict the economy and slow the economy starting in 2022. So they begin this path of increasing rates steadily over a number of meetings to a peak that we hit of 5.5%. So essentially from banks being able to borrow or lend to each other on an overnight basis for almost zero, all the way to 5.5%. A very, very drastic change in interest rates. So 2022, as this was happening, was actually a very challenging year for financial markets, both in equities and in fixed income, because of this radical change in policy in response to higher inflation. So we hung there at a 5.5% target that is looking like it'll be the peak for this cycle, because in the last few meetings, the Federal Reserve has actually started to bring down rates to what we will think will be a more historically normalized level here in the next 18 to 24 months. So they moved in the first rate cut at the end of the summer to a target rate of 5%. And then last week, the day after the election, they moved to a target of 4.5 to 4.75%. So we've had two rate cuts of 0.75% or 75 basis points. The expectation would be that the Fed meets again in December, that we would have another rate cut in December, so they would get a percentage decrease in the 2024 period from the height of 5.5% to probably end this year at a 4.5% target. So more to come on that, and we'll look at sort of the Federal Reserve and their outlook from here. So the discussion around the change in interest rates and how inflation is measured is really interesting, because this is a really good look at the cumulative effective inflation. So that year-over-year percentage change is instructive to understand how prices look today relative to where they were a year ago, but it doesn't actually measure the total change in prices. So while the rate of change is now lower, because we've now retreated back to about that 2.5% level versus a year ago, prices are still materially higher than they were at the start of the decade. So if you look back to the 2010s period where inflation ran, in that 2-ish% range, the cumulative effect of prices over that time was 19%. From the 2020 decade just through 2024, we've already surpassed that at 22%. So this decade is setting up to be, barring some sort of deflationary period, a materially higher cumulative inflation period in this decade versus the decade previous. So there are implications for that, obviously for consumers, for borrowers, for purchasers in terms of, and for employers and nonprofits in terms of cost of employment specifically. So very, very interesting anecdote here. So where are we now? That's sort of setting the stage for the last couple of years. So here in the U.S., so gross domestic product, annualized rate, we're targeting. It looks like right now, so the Federal Reserve Bank of Atlanta forecasts a sort of a real-time GDP figure. So they're saying we're looking at 2.5% will be the number for 2024. That is a real rate of growth, so net of inflation, and that's been driven largely by consumer spending and also business investment. The labor market had been very strong coming out of the COVID period. Again, we saw unemployment rate move much lower. We have started to increase the rate of unemployment back over 4%. So we're running around 3.5% for most of last year and the beginning of this year. That number has started to move higher. So there's sort of a consensus view that the labor market is weakening, maybe through increased layoffs. There's also data that actually shows that this unemployment rate might be increasing based upon higher labor force participation, which ultimately would be a good thing. So corporate profits will sort of probably tell the tale for the equity market. We'll talk about valuations as we continue to move on. We have a good chart on consumer sentiment. I think that cumulative effect of inflation is very much affecting consumer sentiment. But inflation, for the most part, is under control. So, whether the Federal Reserve was able to pull off the quote unquote soft landing is still to be told. But they've done a pretty good job. So the dual mandate being stable prices and maximum employment. Obviously, they had to in the most recent period get stable pricing under control, and now they're trying to do that without forcing massive or another big spike in unemployment, trying to keep the unemployment rate low. Talked a little bit about interest rates, and we'll talk a little bit more about that. We would say risks. If you look out, over the intermediate and long term period, there's a few. So we obviously put the election behind us in last week. We would say valuations, especially on the equity front, are a risk. We'll look at that, especially in the U.S. and in large company stocks. The outcome of the election is known, but the full implications of the election are not known. So, what do tariffs look like? What are tax implications over the next 18 to 24 months? Those are things that we will continue to the market will continue to learn about and process and analyze. And then the geopolitical climate is also probably a byproduct of the election that is somewhat unknown, and what happens in Russia and the Ukraine and China and Taiwan and Israel. So obviously broad-reaching implications across the geopolitical landscape that'll be at the forefront of the market view. So talked a little bit about this and where we are in terms of interest rates. So the Federal Open Market Committee, made up of various members across the country. This is their projection of where that Fed funds rate is going. So think of that Fed funds rate as the shortest interest rate in the market. That is the overnight rate. There are a lot of other benchmark rates that people look to, the 2-year, the 10-year, the 30-year. But the Federal Open Market Committee really is focused on setting that overnight borrowing rate. So this is the median in the gold line. So they're expecting that by 2026 we will reach sort of a long-term rate of less than 3%, about 2.75%. As a reminder, right now, we're right at 4.5 to 4.75 is the range. However, there's a lot of discrepancy amongst the voting members of the committee about where we'll actually be. So that's the median. It's also the highest sort of survey point. But there's a voter on there that thinks we'll be sub 2, and there's someone that thinks we'll be close to 4. So just really wide dispersion. And if you go back to the beginning of 2022, not a single one of them was anywhere close to thinking that we'd end the year at the 5.5% level that we did. So it's instructive. It's interesting. It has not historically been very accurate. Again, this is sort of what the market is pricing and what the expectations are, but not something that necessarily we're using to make long-term investment decisions. So with that, though, if rates are going to continue to potentially move lower, and we have slightly more accommodative policy, this chart looks at the net percentage of banks that are tightening their lending standards. So when borrowing gets more expensive for banks, they charge more to borrow from them naturally, and the opposite happens as rates come down. So in recessionary periods, banks also have higher defaults from their borrowers. So so they get more restrictive in terms of their lending. So across 3 categories, commercial and industrial loans, residential mortgages, and commercial real estate loans, the expectation is that borrowing gets easier. So that is stimulative for the economy and really a positive when you think about where we might be going in terms of access to capital. The implications also for real estate prices, for everyday consumers in terms of mortgage borrowing capacity, and so forth. So and again, of course, small and medium-sized businesses that rely on commercial banks to help fund their operations. So we've been in a really unique environment, which is shown here. it's not typical that you charge someone less interest to borrow on a very short basis, as opposed to charging someone on a longer term basis. So, traditional banking says you borrow short and you lend long and you make a spread on the difference between those rates. That's what you had in 2020. This is August 4th of 2020. Really, so post all the rate cuts from the pandemic earlier that year. 3-month Treasury close to zero, 2-year in there. This was the low point of the 10-year. When you look back at the past 4 years, sub 1%, and then the 30-year, up above, up closer to probably 1.25, 1.3. So the whole curve shifted higher over the past few years, but especially that area that the Federal Reserve is influencing the front end of the curve. So the peak inversion period was July of 2023, where you had really the highest point of short-term rates being higher than long-term rates. So here you had short-term rates up above 5%, in the 10-year right about 3.8%. Fast forward to October of last year, this part of the curve moved much higher. So all rates kind of moved higher, except for that front end was pretty sticky. And where we were at the end of September was that everything started to kind of shift back down versus a year ago. So still you have this inversion here on the front end. So after the Fed rate cut last week, the 3-month is about 4.5. So this is starting to come down. But still you have this short end, slightly higher. We're almost exactly flat across the entire curve today, right in this range from 4.5 to about 4.2 to 4.3 out here. So, right now, after the election and after the Federal Reserve meeting last week, we're pretty flat right in this range. So, again, rates materially higher than where they were in August of 2020. And we would probably argue that that's probably not going away anytime soon. So the inflation expectations, obviously, and realized inflation have come down, but the effect on the consumer is not moving in tandem. So on the left side here, you have year ahead inflation expectations. So again, pandemic, inflation realized and expectations moved materially higher. And the percent of consumers citing higher prices for worse personal finances had followed that pretty closely. You see this red dotted line pretty much operating on a lag to actual realized inflation and expectations. So now expectations have come down, and what has not moved is the effect on consumers. So to be determined if the cumulative effect that we showed, being much more dramatic so far in this decade, is truly impacting consumers to the point where they will not spend as much, they may be saving more, they will not be as additive to the economy, or that this operates on a lag, right? And it just takes some time for either wages to catch up, or other factors that could influence consumers feeling better about their position in the economy. But this is a concerning picture, we would say. So this reiterates that picture. This is the index of consumer sentiment. It's been measured really since the early 60s. 1966, they put the value. We've kind of gone backwards and put the value at 100. That would be sort of that neutral level, going back to almost the start of the data set. And then it kind of fluctuates anywhere between, call it low 50s to about 110. And the higher the gauge, the better consumers are feeling, and the lower the gauge, the worse. So typically in recessions, you have consumer sentiment being pretty low, which would make sense. Obviously here's the 2008, the global financial crisis. 1980 period, the 80s period coming out of the 70s, very high inflationary period. And then, kind of post-COVID, that we had very low consumer sentiment. And that is interesting in terms of our everyday sort of workers and ourselves and those that we work with. But for investors, that actually may not be a bad thing. This is a really interesting chart from our friends at JP Morgan that looks at the subsequent 12-month returns of the S&P 500 at various sentiment levels. So here was that May of 1980 period, and the October of 1990 period. So the fall of 1990, again, coming out of this period, we were also starting, the Gulf War was starting in October of 1990. The subsequent 12-month return was nearly 30%, at a trough in consumer sentiment. January of 2000, people were feeling pretty good, just before the tech bubble. Consumer sentiment was up about 110, negative 2% 12-month returns for the S&P 500. In November of 2008, consumer sentiment was really low. 12-month returns were plus 22%. In April of 2020, in the middle of the pandemic, subsequent 12-month returns were plus 43%. So investing at sentiment peaks, the forward return is plus 3.5%. And investing at sentiment troughs, the forward return is plus 24%. So it is actually paid to invest when consumer sentiment is low, again, going back to the 1970s. So where are we headed from here? So we can say with somewhat confidence that we're probably in a period of rate cuts, right? We just don't know really the velocity and the degree at which we'll realize them. So this is a period where you look at 6 other historical periods where the Federal Reserve has cut rates. This left-hand chart is the S&P 500 returns, and the right-hand chart is bond returns as measured by the 10-year over the subsequent 24 months. So October, or our first rate cut, actually earlier this year, is really this dotted line. So we're about right here. So in the months leading up to, you have a lot of variance. Aside from the 2007 and the 2001 period, you've had fairly positive S&P 500 returns, ranging from about 16% to over 70% in the 95 period. And in every case, going back over these historical periods, fixed income has had positive returns in those periods. So again, instructive to look backward, not what we completely rely upon, but do study history to understand the context. So again, we've had an election in the United States last week, and this chart looks at the performance and really the growth of $1 invested in the S&P 500, going back to Kennedy in the early 60s. And what tends to matter, we would say, more than, so obviously long-term growth, regardless of sort of political party that is in power. And we would say what tends to matter more is progress and innovation and earnings and growth in our society, in our economy, and whether or not that is either supported or hindered by political parties over time, feeds into this. But the global economics is not incredibly influenced by who's leads the executive branch of the U.S. government. So what does that mean for portfolios and how we manage money for nonprofits specifically? Well, the reality is that U.S. stocks are expensive right now relative to history. So if you look at the price to earnings ratio of the market, long-term average right here in this about 16 to 18 range. So price to earnings ratio, take all the S&P 500 companies, take their earnings per share, and put a dollar valuation on it. And the market trades today, the S&P again at about 6,000 level. So there's a multiple of all those earnings, which is today about 22 times forward earnings. The one standard deviation above the long-term average is at 19.8. Stocks are cheap when they're in the low teens. Again, we're at about 22 today. This is a chart from Charles Schwab that looks at really a number of different valuation metrics. Schiller, CAPE, Tobin's, market cap to GDP, everything points to US equities being expensive, which doesn't necessarily mean that we don't invest in them. We just probably need to think about what the trade-offs between investing in the US versus other areas of the market. And the really good news of this is the market got very expensive by doing very, very well. So performance last year and performance this year in portfolios has been quite strong. So you kind of take that implication, knowing that performance has been very strong. So contrary to that notion, though, is that right now we think that actually equity gains can broaden. So the S&P 500 has been largely driven by appreciation in a very concentrated number of stocks that in truth are the best performers when you look at profit margins and operating margins and how much cash they have to work with and how they're running their businesses. They're very strong. But this looks at a number of other sectors that we think over the next 12 months should have positive earnings that are not focused on information technology and communication services. So we've talked a lot about the S&P 500. What also needs to be at the forefront for investors, we believe, is a global view of investing. So while the price earnings ratio of the S&P again is right around 22, which is higher than that 15-year average of 16.6, Europe, Australia, and the Far East is trading at 14.4 times. In emerging market economies, think of India, South Korea, Taiwan, China, Mexico, Brazil, trading at 12.5 times. So which is well below their 15-year averages. So again, the dispersion between these lines, US, Europe, and Australia, and emerging markets, and Japan in here as well, has widened dramatically, which points to relative cheapness of international to the US. Important to keep in mind too, they represent 36%. Those other economies outside of the US represent 36% of the weighting of stocks on a global basis. So US equities are 36% of the all country world index. Europe ex the UK 11%, emerging markets 10%, and Japan still 5%. So we think it's a tough call to ignore international equities at this point. China's really on the opposite end of where we are in terms of fiscal policy as well. Obviously, a large economy for our world, and they're actually embarking on stimulus, so it could be a tailwind in that emerging markets category. We're very constructive on fixed income right now. So if fixed income has more confident returns than equities. Equities tend to bounce around a lot. Show a couple slides on that. But in fixed income, barring big default movement, if you hold a bond from the day you buy it to the day it matures, you're going to collect your yield on that security. So you can tell with more, again, confidence what your return is in fixed income is going to be, and yields are higher. We showed the chart going from 2020 to where we are now. Yields are more competitive in fixed income landscape than they have been really over the past decade. And that's what this chart shows. So go back again to the 80s, very high inflation period, high interest rates. Your starting yield at those times was 9% plus, and your return was commensurately higher. The 2010 decade that we just left, yields were very low and returns were very low. So, we're marching up this scale, about 4.2% current yield. So, go back to a very, very long, 50-year plus time horizon, and rates not looking extremely high, but in the most recent period, again, coming out of the global financial crisis of 2008, rates are starting to move higher, which points to again, higher returns in fixed income. So we really think that stocks and bonds work together. We'll also talk about alternatives, as an implication. But this is a great chart that looks at sort of the return over different time periods. So this green bar is equities. Equities in any given year go back to 1950 through last year, and the range of this bar is over a 1-year period. The best year for stocks was up 52%, and the worst year was down 37%. Bonds, the best year was up 33%. The worst year down 13%, 2022. And then in a 60-40, the range positive 34 to negative 20. So obviously a very wide range, especially for equities over any one time frame. If you look at a rolling 10-year or rolling 20-year period, stocks have had a negative rolling 10-year return period, but the best year was plus 20%. A 60-40 portfolio going back to this time series, over a 10-year look, has never had a negative return on a rolling basis. So plus 16 to positive 1%. As the worst period. So, again, we think that it's not just stocks, it's not just bonds, it's the mix of them. And we'll talk a little bit more of that too, because we also tend to include alternative assets when thinking about nonprofit portfolios. So this year we had a brief pullback in July, but other than that, we've been pretty much straight up. So this is September 9th. So this positive bar is about 20% at this point, but essentially looking at the return of stocks per year and sort of the final number. So look at last year. We ended up 24%. We had a 10% drawdown in that year. In 2008, stocks had a 49% drawdown and finished the year negative 38%. Bounced in 2009, but still had a 30% drawdown in that year over the course of the year, but finished positive 23%. So, big corrections typically happen once a year, and not uncommon. It's normal to see a 10% correction despite the overwhelming majority of annual returns being positive. So we look to just further diversify portfolios in anticipation of more volatility. You look at 2022, which we mentioned was a very difficult year. So the intra-year drawdown of various asset classes, global equities were down 25%, bonds were down 14% at the worst. They actually ended up down 13%. Stocks ended down 14.5%. But diversifying asset classes while we're down. So look at this is hedge funds drew down 7%, less than bonds. Real assets, which respond to inflation, actually ended the year positive, up 3.2%. Private debt ended the year up 6.3%. Private equity was down over the course of that year with more equity-like characteristics. But of these alternative categories, 3 out of the 5 actually ended 22 positive in what was a really, really painful year for both stocks and bonds. So helps mitigate from volatility. Also, has tended to improve diversification over time. You look at volatility here horizontally and returns vertically, and think of this very simply: a 40% stock portfolio, 60% bonds. about a 7% historical return. The 80-20 portfolio up closer to 13% on volatility and 9.2% on annualized returns. The 60-40, sort of that traditional portfolio, 8.4% return, 9.7% volatility. Taking that portfolio and moving it to a 40 equity, 30 bond, 30 alternatives results in lower volatility and higher annualized returns, pretty materially. So again, thinking about access points to different asset classes that insulates from drawdowns and helps improve diversification. We think in this type of environment make a lot of sense. We tend to focus a lot on publicly traded securities because that's what's in the news. If you look at actually, businesses in the United States that generate $100 million in revenue, 87% of those businesses are still privately held. So there's a sort of a great behind the scenes America that's outside of the stock market and the news. Your real estate prices, have been an area that have been challenged. So the way that traditional real estate is valued is, you look at net operating income and put that over a cap rate. So as rates move higher, there's sort of a mechanical adjustment to real estate prices, but also, we've seen major shifts in demographic trends and corporate trends in the office space. So a really big correction that you saw in offices, especially downtown office. Was prices down 35% in those areas. Less dramatic in the industrial space and really retail. And then suburban office hung in there pretty well. Apartments, again, if we see rates coming down, you'll have that mechanic adjustment of prices higher. Also, rents tend to be tied to inflation. So implications, obviously there in a higher inflation environment. This is a reality of where we are as a country. The national debt, set to eclipse 35 trillion. And that's almost, you're almost doubling from where we were pre-pandemic. So those are just really, really big numbers. Talk about election implications. I'm not sure that balancing a budget is at the forefront, which probably means that we're in a higher inflation, a weaker dollar, higher inflation environment more generally. So real assets would be an area that we would look to. Private infrastructure has performed very well during periods of above average inflation, better than stocks, and bonds are negative in those periods. We also believe there's a massive unmet need for infrastructure spend just across the globe. This is GDP measured out in trillions. The annual infrastructure spend is estimated to be the third largest economy in the world after the United States and China. So there's a massive unmet need there. But hedge funds are in decline, and they've been sort of a bellwether investment for investors and especially institutions for a long period. But we saw in 2024 the first net asset flow going back to 2018. So what does all this mean for you all and your portfolios? We really caution against spend a good amount of time understanding where we've come from, but we're constantly trying to skate to where the puck is going. So instead of looking backwards or being emotional, it's really a matter of this is a really good chart, and could be you could apply this chart to probably a number of different areas of the market today. But we saw it in the sentiment chart, right? These periods where things are exciting and then everything is well in the world tend to not be great times to be investing versus when there's desperation and panic and we reach the lows. Those returns tend to be stronger. So we think that you need to look forward. You need to be focused on asset allocation and diversification. You need to be looking for new opportunities like things like infrastructure, and know that forecasts are instructive, but they're going to be imprecise. Again, you look at the Federal Reserve in 2022. We are good at predicting the future, except for surprises, which tend to be the most influential factors. So Some of the things that we're doing for nonprofits are thinking very, very specifically about the use of funds. So when we work with clients, we talk to them about what are your goals and your needs for a pool of assets that you may be thinking about investing. Are they operating backstop, cash management, funds that you may need? Are they strategic opportunity funds? You may be building a building or taking on a big project or buying something in the next 2 to 5 years. Is it an endowment? Is it a foundation? Those are all different pools that have different return targets and risk and things that those portfolios look very different relative to one another. So have a plan, have a good plan, document the plan, and think about what every holding in the portfolio is doing for you. If you don't understand that, those are things to be talking with folks about. Where's your growth going to be coming from? How are we protecting against a higher inflation environment? If we are in a recession, what are our assets that should be protecting the portfolio in that type of environment? And again, the goal being that you would hit your return targets without taking on excess risk, and you'd have ability, like, we don't know where the market is going, right? But we do know that if the market goes down and it gets cheap, we're going to buy more of it. Where am I going to get that capital from? How correlated is my fundraising to stock performance? Right? Like if I'm heavily reliant on a donor base that are personally investing, it's probably harder for me to raise money in a 2008 type period. Well, maybe my portfolio should reflect that reality. So just a couple of examples of what portfolios might look like. Again, a short-term funding account, not going to have a lot of stocks or really diversifying strategies. You're going to have a lot of fixed income, especially now, where you can earn 4 to 5%, pretty confidently and pretty comfortably with not a lot of volatility. But that portfolio is going to not have much more upside than that about 5% level, versus like a strategic projects fund that might have half equities and half bonds and half diversifiers, or alternatives. And that may be more trying to make a 7% type of portfolio versus one that's very long-term in nature, can withstand volatility. You're going to have periods of drawdowns in that type of portfolio. And how do you just manage that? Well, you have the ability to rebalance that portfolio, and that, theoretically should be your highest type of return. You can have more illiquidity in those types of portfolios as well. So the National Association of College and University Business Officers survey is out with the most recent data from fiscal year 2023. Spending rates are up, which I think reflects, again, a higher yield environment, more confidence in the income that you can generate from portfolios. So that's a good thing. We also had counseled many clients to be closer to that 4% spend rate. That are starting to trend a little bit higher, especially as inflation is higher, and you're trying to keep up. This looks at asset allocations of such endowments. So a couple of things that I would point to. This looks at the size of institutions from under 50 million all the way up to over 5 billion. And what you see is that the amount to equities goes down as a trend across, as you continue to move higher. Also, your amount to bonds goes down. So that's fixed income here. This bar is moving obviously more narrow as you go across. So where are those assets going? If you're doing less stocks and less bonds, they're going into private equity and venture capital and infrastructure investments and real assets, things of that nature. So that's a trend. If you look at fiscal year 2023, that actually didn't help the big guys nearly at all. So the best performers were those in the smaller category, even under 250 million, that tend to have more public securities, because, and this will be the same for this year, maybe not on a fiscal basis, but calendar year 2024, where public equities do materially better than private investments. That'll benefit the smaller endowments more so than the large guys. So a couple of things that we try to help with are, again, ways just to engage donors, whether that be a webinar like this or reporting or newsletters. anything of that nature. We've been having a lot of conversations with our clients, both on our institutional business, working with endowments and foundations and nonprofits, but also our family clients that potentially have pledges outstanding to organizations. This is a great time to be trying to fast forward pledges. So what that means is if I made a 3-year pledge and I'm going to fund that to an organization, I'm going to fund that with appreciated securities. It may be worth a call from your development team to those folks, potentially asking them if they want to look at accelerating that because their stocks this year are highly appreciated. So if I'm going to gift that with Apple that I've owned, for the last 25 years, now is not a bad time for me to think, as an advisor too, for me to talk to clients about potentially just making good on that full pledge right now. So that's a great real world application. We would say for you all is again focus on gifts of securities as opposed to cash gifts, and also think about market performance relative to where you are in that cycle. I'll just leave you with one anecdote from Warren Buffett, and this applies to individuals and nonprofit institutions. But investing in financial markets, stocks, bonds, hedge funds, alternatives, private equity, real estate, these are not meant to be short-term solutions to long-term problems. You win in this game by doing the same thing over and over again for long periods of time and not taking on excess risk. Warren Buffett, one of the most well-respected investors in the history of the world, he made over 90% of his net worth after he was 60 years old. And that, just a good reminder that it's not necessarily timing the markets, but time in the markets. So with that, I will open it up for questions.
Thanks, Christian. I think that last slide is perfect. In Invest, we talk a lot about process over prediction, and you make a good point with Warren Buffett. So we have a couple questions in the chat, and the first one is, why are the banks of China and Japan so different from other banks? Are their economies so much different, or are they not trying to manage inflation?
Yeah, so two totally different, it's a really good question. Two totally different, I would say, answers for each one of them. Japan has been battling for a very, very long time, just demographic headwinds. You will see that their inflation didn't spike as much. They are not, their economy just isn't growing and not responding to the degree at which you would see in the US and Europe. In China, more nuance. I don't know exactly, what I would say to that, aside from the fact that, again, they've been in more of a demographic slowdown as well. They are one of the world's largest economies. Data out of China is generally less reliable. So, it's harder to make, strong read-throughs there. Now we know what their interest rates are, and they are, now being more stimulative, but I think there had been working through a really big backlog of kind of over stimulus and overbuild there. That happened in the previous 20-year period.
We got a quote in the chat or in the Q&A. The first billion is the easiest. It's a quote from Warren Buffett. So maybe laugh.
Exactly. Yeah. Then you start compounding.
That's right. And then our next question, is there any research on the inefficiency of the private debt and equities market, and whether or not that inefficiency has been worked out of the market by volume and interest?
Yep, another great question. Thank you. So there's, just to take a quick step back, a large contingent of investors believe that it's really hard to win by stock picking in something like the S&P 500. So there's a lot of public information about all those businesses. There's a lot of analysis done around how much they're earning today, the quality of the earnings, and what those earnings look like in the future. So you should just, again, this line of thinking believes that you should just own those indexes and not try to own any subset of that 500 because it's really hard to win and it's expensive. So this question points to the private side and says, well, there's a lot less publicly disseminated information, and so should there be an edge to investing in privately held businesses? The answer to that we believe is yes, in the fact that you can win, you can be much more selective in the types of businesses that you invest in that area. As these asset classes continue to proliferate and get used by more and more investors, does that go away? To be determined. I would say it certainly probably goes down. But you also, I think that's a really instructive slide that we showed about the number of the percent of companies, and how they're generating revenue, and how so many of them are still private. I would also say that there is demographically a massive unmet need for small and medium-sized business transition that needs to happen over the next 25 years. So you still have so many entrepreneurs, that are now from that baby boomer generation. They're now approaching what is their succession plan, and family's not always the answer, and we believe that private markets are part of that solution.
We have one more question, and we have one more Warren Buffett quote. The next quote is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." The next question is, why are the mortgage and lending companies not responding with lower rates to the recent rate cuts?
Yep. So they are. So think of their business model, right? They need to be issuing mortgages to be profitable, right? They need to do volume. So it's not so much that they don't want to be doing that. And by the way that they would be able to generate volume is by making mortgage rates lower. Think of how the vast majority of homeowners refinanced, in that low rate environment, right? That's good for banks to have volume. They're being faced with the reality that their borrowing cost is still sticky. So for them to lend to you at a rate, they have to be making a spread, right? So they are taking in their borrowing to lend it to you. So it's just the reality of where sort of that shape of that yield curve looks like, for them to be able to price effectively. But they're trying to get to a point that's attractive for borrowers, but also remain profitable. So so by rates not moving, that's telling you that they're kind of stuck in the middle there.
Okay, last question. We have about 1 more minute. And yes, we will be sending out the slides after the webinar is over with the link to rewatch it. Generally, most colleges and universities are affected by dropping enrollment. So how much does this drive the increase in spending from universities' better returns on their investments?
Yep, great question. And probably, some of that dropping enrollment is due to the massive surge in the cost of education, over the past 20 years. So, or 50 years, or however long that trend is out there for. So the answer to that is often from the endowment, right? Like that's the plug figure for financial aid for most institutions. So, but think about the other side of that coin. When we talk about rising inflation and what that's going to mean for wages, your staff and your professors and your teachers, the cost to employ those people is also moving higher. So it's sort of all moving up kind of together. But yeah, that does, that's going to want, I would say, the natural tendency is going to want to backfill that from the endowment. As an advisor, we would caution against, relying too heavily on if you want an endowment or a foundation to be a perpetual life vehicle, the way that's accomplished successfully is by not putting too much stress on that pool of assets from a spending perspective. So those are your trade-offs there. Trying to backfill that from the endowment, but also not putting stress on that, so you can, because your worst case scenario is market draws down by 20% and you draw 7 or 8%, off that pool in a given year. So again, that's why the insulating on the volatility piece is so important.
Right. We don't have time for all the questions in the Q&A, so we will reach out to you with answers to those questions. And I want to thank Christian for his expertise here with this presentation. There's always something going on with the economy, and we look forward to these economic updates. So thank you, Christian.
Thanks, everyone.
Okay, next we have Sherman and Howard and Taft. And from Sherman Howard Taft, we have John Melkin and Taylor Hughes. Let me just give a brief bio for each of them, and then we will dive into their presentation entitled Legal Issues for Nonprofits, Endowments, and Employment. So John Melkin provides comprehensive legal counsel to educational, religious, and nonprofit organizations, focusing on employment issues and risk management. Prior to law school, John spent a decade working in the higher education sector. After graduating from the University of Virginia School of Law, John clerked at the U.S. Court of Appeals for the Fifth Circuit. He is currently an associate in the Colorado Springs office of Sherman and Howard. And Taylor Hughes helps nonprofits and commercial entities with their tax needs and other corporate legal matters. Taylor began his career as a CPA at EY. He later attended the University of Virginia School of Law and worked in the office of the Chief Counsel for the IRS in Washington, D.C. Taylor's experience includes co-founding a nonprofit focused on helping individuals experiencing homelessness. He is currently an associate in the Colorado Springs office of Sherman and Howard. So with that, Taylor, I will let you take it away.
Great, thank you, Sarah. Hopefully you all can see our slide presentation here. Hello, everyone. It's a pleasure to be with you from our office in beautiful Colorado Springs. As Sarah mentioned, I'm Taylor Hughes, and I'm joined by John Melkin, who you'll see in just a little bit. Our presentation today will be giving a legal update for nonprofit organizations. So in the first part, we're going to go with the theme for today's webinar and focus on a hot topic in the world of endowments from the past few years, or really since the pandemic, which is what are the legal options for obtaining increased access to endowment funds? Something we got a lot of questions about the past couple of years. But to understand this topic, it's important we cover some foundational aspects of endowments, including the different types of endowment funds and MIFA, which is the primary law that applies to endowment funds. So we'll start there and then move into the more specific question about obtaining more access to endowment funds. And then finally, since there's not a whole lot of new developments in the world of endowment funds, my colleague John is going to jump in for the last portion of the presentation to cover some changes in employment law that we've been receiving lots of questions about in the past few months from our nonprofit clients. So with that plan, let's jump into some endowment fund basics. What is an endowment fund and why would an organization want to create one? Well, under the applicable law, which we'll discuss here in a little bit, an endowment fund is defined as a fund held primarily for investment purposes that is not wholly expendable by the institution on a current basis. In other words, there's a time restriction on the use of the funds. There may also be purpose restrictions on the funds, but it's the fact that the fund cannot be spent for a certain number of years or perhaps in perpetuity for a portion of the fund, or until a triggering event occurs. That's really the distinguishing feature of an endowment, this time restriction. Now, why would an organization agree to such a time restriction? Well, when established and managed correctly, an endowment can provide consistent long-term funding for programs, which relieves pressure on an organization to find donations year in and year out. And from the donor's perspective, they like the idea of creating something that's going to last beyond their own lifetime and hopefully sustain an organization's operations and purposes for generations beyond their own, right? But as we'll see, these time restrictions can be both a blessing and a curse, and we'll talk about that more. So you'll hear me reference MIFA throughout this presentation, so let me just up front give you a quick intro to what I'm talking about. MIFA is the primary law that applies to endowments. It's short for the Uniform Prudent Management of Institutional Funds Act, but almost everyone calls it MIFA because it's so much easier to say. MIFA is a uniform law that was created in 2006, and it's been adopted now by 49 states and Washington, D.C. at various times since 2006. I believe Pennsylvania is the last holdout state. For me, I would have put my money on New York or California to hold their noses up to a uniform law, but not this time. Pennsylvania has their own unique law in this area. So anyway, UBMIFA is not limited to endowment funds, but applies to any institutional funds, which are defined as funds held for exclusively charitable purposes, primarily for investment. Its purpose is primarily twofold. It's addressing guidance on investment of these institutional funds, as well as the expenditure from such funds. It wasn't created in a vacuum. Its predecessor was confusingly called UMIFA, so UPMIFA, but without the P. And UMIFA was a pretty old statute from 1972, based primarily on trust law concepts. Although it did provide some updates, and UMIFA recognized some additional updates based on changes in investment strategies and how organizations view and donors view charitable funds. Now, there's a couple of important things to note about UMIFA. Although states that have adopted UMIFA tend to call their statutes simply UMIFA, don't be fooled. They're not necessarily the same statute. States have adopted their own unique adjustments to UMIFA, and some of those adjustments are small, while some are bigger. So you have to be sure that you're looking at the particular state's UMIFA statute that applies to a particular endowment. So for purposes of this presentation, when I reference UMIFA, I'm going to be referencing the version that was proposed for adoption by the states. But just remember that the exact terms of the UMIFA statute that's going to apply to your organization's endowment may be slightly different than what I talk about today. And I'm going to try to note some areas where I've come across some important differences between the states in my practice. The second thing to note is that UMIFA is enforced in each state by the state attorney general, or in some states it might be a different official, but there's going to be some official in each state who's charged with protecting the interests of donors in that state. And that official will be able to enforce the terms of UMIFA. So even if an organization can't identify a specific donor who may raise an issue with its use of certain institutional funds, just remember the attorney general or another official will always be able to step in on behalf of the interests of the citizens of that state and enforce UMIFA's provisions. Now, it's important to understand that not all funds called endowments are created equal. There are three primary types of endowments, and it's important that organizations can identify which category their particular endowment falls under. So the first type of endowment is what most people think of when they think of an endowment. It's the permanent endowment, or what also is referenced as the true endowment. And this is created by a donor, and it's meant to last in perpetuity. So again, this is what most people think of when they hear the term endowment. The second type of endowment is a term endowment, which is similar to a permanent endowment in that it's also created by a donor, but is not necessarily intended to be permanent. Rather, the funds can be spent after the termination of a certain number of years or upon the occurrence of some triggering event. So in other words, it has a set term, thus the name term endowment. And the last type of endowment is quite different than the first two. It's called a board designated endowment. And the reason why it's different is because it's not created by a donor. Thus, there's no donor restrictions on the funds, but as the name suggests, it's established by an organization's governing board. And so because it's only the governing board who's created this and set the terms for the endowment, these endowments are subject to very different rules, and they're free of many of the rules that restrict the use of permanent and term endowments. And we'll go through during this presentation many of those differences, but there can be significant advantages for charities who hold board designated endowments as opposed to permanent endowments or term endowments. So as I mentioned, it's really important that organizations correctly identify what type of endowment they're maintaining. So let's talk a little bit more about permanent endowments and board designated endowments in particular. And I'll start with an example. Let's say your organization receives a $100,000 check in fulfillment of a gift agreement. This simply says the money is for the establishment of an endowment. Under applicable law, this is going to be considered to create a permanent endowment. Now note, the gift agreement didn't say anything about a time restriction. It didn't say anything about the funds being held in perpetuity, but the word endowment itself was enough to create a permanent endowment under the terms of UPMIFA. Now, what if the gift agreement didn't use the word endowment, but instead said the donor wishes for the recipient organization to use only the income generated by the investment of the funds? Again, this is going to create a permanent endowment. So you can see it's recognized by the law that terms like endowment and certain instructions to use only the income or to preserve the principal are generally read to create a permanent endowment. The only caveat to this rule, as you can see on the slide, is that if there's something else in the agreement that indicates this is not the intent of the donor. So for instance, if there's a time or purpose restriction that would be inconsistent with the permanent nature of a permanent endowment, then we can look at, okay, maybe this is not a permanent endowment, maybe it's a term endowment or something else. Notice, however, that one of the requirements here is that there be a gift instrument. So, this is one way that the law provides some protection for organizations and for donors, in that you can't create a permanent endowment unless you have a gift instrument in writing. A verbal agreement is not going to generally be sufficient to create a permanent endowment. So moving on, then let's compare that to a board designated or quasi endowment fund. I've included here two definitions of quasi that I found by just quickly doing some Googling, and I think it's helpful in thinking about board designated endowments. As a lawyer, when I hear the term quasi, I cringe usually just a little bit, because usually quasi is some type of scheme to convince me that something is what it's actually not. And so I think that skepticism is reflected in the first definition there, seemingly or apparently, but not really. It's not really what it is. And in this case, that's sort of true. It's not really an endowment. But there are certain characteristics that make it similar to a permanent endowment or term endowment that can be very useful for both organizations as well as for donors. So on the one hand, it's really important from the donor's perspective with a board designated endowment to understand that a quasi endowment is not an endowment in the sense that the organization is not legally obligated to maintain whatever time restrictions are imposed on the use of the funds, or purpose restrictions for that matter as well. These endowments, if you want to call them that, are created by the board of the organization and are subject then to board action, modifying or removing any restrictions in the future. So that's a big difference, and something that we need to make sure donors understand when they're donating to this type of endowment fund. Additionally, many of UPMIFA's provisions and restrictions, both on spending as well as on modification of funds, don't apply to board designated funds. So to the extent that organizations are seeking donations to board designated endowments, we just want to make sure we're clearly communicating the terms and of these endowments and the distinction from permanent endowments to avoid any types of misunderstandings. Now, on the other hand, thinking about that second definition of quasi on the last slide, Board designated endowment funds do share some attributes with donor created endowments. So the primary one is that the fund is usually going to be managed in a similar manner to a true endowment, with the goal that the principal is maintained over time and the investment returns are what fund the organization's activities. So by setting aside funds for investment, the board is helping to protect the future financial security of the organization. Additionally, while not required, the board can designate funds toward a specific purpose or program for the long term. So this can still be a very useful tool for fundraising because it demonstrates to donors that the organization is committed to whatever purpose or program that's been designated for the long term. So you can see how that can still be a very helpful fundraising tool and why it would still be attractive to donors. But that's why these are called colloquially quasi-endowments, because in some ways they're not really endowments, but they function similarly in some respects. So to put a finer point on the difference between permanent or term endowments and board designated endowments, here's a chart showing the legal framework for each. So looking at the left side of the chart, when considering the restrictions on the expenditure and investment of permanent endowments, we first look to the endowment agreement that's been signed by the donor that created the endowment. And when the donor's intent is clear, then we don't need to look any further than this document for guidance. However, in many cases, and you may have experienced this, endowment agreements are not entirely clear, or they use general language. And so that's when MIFA is going to step in and apply to fill those gaps for the organization. Now, contrast that with the right side of your slide, which is addressing board designated endowments. These are governed simply by any board resolution setting the funds aside, as well as any board policies that may apply to it, such as if your organization has a general investment policy, that may apply to the investment of the funds in the board designated endowment as well. So as a result, there's far more flexibility and freedom for organizations to manage board designated endowments than permanent endowments or term endowments. So now that we understand the basics of endowments, let's talk about the main topic for this presentation, which is how does an organization obtain increased access to endowment funds beyond what their current spending policy provides for annual appropriations? Many organizations that rely on revenue sources like event revenue looked into this question during the COVID years, when they all of a sudden experienced significant drops in revenue for one, or depending on where you were in the country, could be several years. Some of these organizations had millions of dollars tied up in endowments that they couldn't easily access to cover the shortfall in revenue. And for organizations with board designated endowments, it was simply a matter of deciding whether the board wanted to take the action to unrestrict all or a portion of the funds. But other organizations had permanent endowments or term endowments and didn't know what their options were. So what I'm going to address in the next 15 or so minutes is what are those options for accessing those funds in an extraordinary situation like that, or in other situations where an organization may need to access those funds. And I'm not only going to talk about this retroactively, but also prospectively too. What are some steps that organizations can take to avoid situations where they can't access the funds when they really, really need them? So as you see on the slide, there are really two primary options for this, with several sub-options that we'll talk about. The first thing I advise organizations to do is to review their spending policy to see if it can be modified to allow the organization to spend more on an annual basis, either for the short term, like during the COVID years, or perhaps for the long term, because oftentimes organizations don't actually understand they may have more flexibility to spend from the endowment than they think they do currently, especially if we're talking about spending for a short period of time. So often adjusting a spending policy is not that difficult to achieve. What's more difficult, and this would be step 2, is obtaining a modification or release of the restrictions. This often requires going to a third party for approval. And so it can take more time, be more costly, and the circumstances under which you can obtain a modification or release are somewhat limited. But first, let's discuss the legal restrictions on expenditures from an endowment fund. So as we saw earlier in the chart, the first place we look to for restrictions is the endowment agreement. An endowment agreement could prescribe a rate of spending that's either more generous or less generous than UPMIFA. Although in order to limit the spending discretion more than UPMIFA, the agreement has to do so specifically. It can't use general terms. It has to specifically limit spending, for instance, to, let's say, 2% per year. That would be more prescriptive than UPMIFA, and would be clear enough to overrule UPMIFA's expenditure policies. Sometimes endowment agreements will include a specific percentage that can be spent each year. On the other hand, it's far more common in my experience, at least with older endowments, that they just include a general statement such as only the income should be spent each year. UPMIFA provides a general rule of construction in situations like that those types of statements should be read to indicate the donor intends the funds support both the current expenditures of the organization as well as to be preserved permanently. So those types of phrases shouldn't be interpreted as limiting an organization to spend only what might be considered income for accounting purposes in a given year. So this is one way which organizations may find that they have more freedom than they realize to spend in a year when investment returns are abnormally low. To the degree that an endowment agreement does not provide specific spending instructions, that's when we're going to look at UPMIFA for the guardrails on what can be spent in the current year. And those guardrails in many states are not particularly black and white, to mix my metaphors. There was a pretty clear limit on spending under the old statute, UMIFA. Under that regime, charities could not spend down the endowment below the historic dollar value of the fund. So in other words, if a $100,000 donation established an endowment fund, the charity couldn't spend down the endowment below that $100,000 threshold. And that was a clean line. But UPMIFA eliminated this clear boundary and did not replace it with a new floor for spending down the endowment. Instead, what the drafters adopted was a prudence standard guided by the consideration of 7 factors, which you can see on the slide. In the commentary, the drafters explained that organizations, in their opinion, had actually become too concerned with the accounting value of endowment funds and needed to shift their focus to maintaining the purchasing power of the fund over time, not necessarily year to year. And therefore, they said a good spending policy should be responsive to both short-term fluctuations due to economic downturn or due to economic strength. And so in some years, accumulation rather than spending would be the prudent choice. And in other years, an institution may be able to appropriate amounts from the fund, even if it didn't generate an investment return in that year. So you can see how this is a much more flexible approach to spending than had previously been assumed allowable under UMIFA. And the goal is to still, however, take into account the intent of the donor that this fund be preserved for the long term. The idea is that the donor's intent is not just that the fund be preserved for perpetuity, but also that the organization receive the funding it needs on a current basis to maintain its operations and programs. Now, MIFA also acknowledges that the multi-factored standard that we just saw on the last slide may not allay the fears of all states that charities will not spend down their endowments and try to just justify their action based on the factors we just talked about. So what they did is the drafters of MIFA included a provision that was optional for the states, and some states have adopted it, which creates a rebuttable presumption of imprudence if an institution expends greater than 7% averaged over a period of 3 years. So again, it creates a rebuttable presumption of imprudence if an institution expends greater than 7% averaged over a period of 3 years. This is one of the biggest differences that we see between the states. Some states have adopted this provision while some states have not. So this is something that I would look at your state's MIFA statute, and your board should be aware when looking at your spending policy, whether they need to keep their expenditures under 7% average. Now, notice a couple things about this provision. First, it's not a prohibition on spending over 7% in a given year. So for example, this means an organization could spend 5% one year, 9% the next year, and then 4% the year after that. And that's not going to trigger this presumption because on the average, we'd be under 7% for those 3 years. Second, it creates a rebuttable presumption, not a prohibition. So there's circumstances where it could be permissible to spend more than the 7% averaged over 3 years. Now, of course, the organization would want to create solid documentation of how it came to that conclusion, and there could be some risk with doing so. But I just want to point out that, again, MIFA is not providing a solid red line that you cannot cross. Rather, it's providing guidelines for the organization and making spending decisions. So with that background on MIFA's spending provisions, to the degree that an endowment agreement does not specify spending limits, an organization wanting to increase its spending from an endowment should review its spending policy to see if it's maximized its possible spending for a given year under MIFA. This is step one in this process before we move on to the step that I think most people immediately jump to, which is how do we unrestrict these funds? Okay, so once an organization has performed this review and maximized their spending under the given restrictions from an agreement as well as MIFA, now we're going to look at, okay, do we need to seek a release or modification of the restrictions on the endowment fund? And again, before I jump into this, I want to highlight the difference between a board designated endowment and a permanent or term endowment. It's much easier to remove or modify restrictions on a board designated endowment because all you need is board action. You don't need to obtain consent from any third party or even technically provide notice to anyone, such as the donors. Although, of course, there's considerations of donor expectations and good stewardship that an organization will want to think through carefully, but these aren't legal restrictions. They're more about relationships and keeping a good reputation as an organization and honoring the intent of donors. But in contrast, with a permanent or term endowment, we're facing restrictions imposed by donors, and so the law is built to protect those interests strongly. I include this cartoon here on the right of the slide because oftentimes I think this is how some donors view endowment funds. They see a multi-million-dollar endowment fund in the financial statements of a charity and assume the organization is set financially. They think the endowment fund is essentially this piggy bank that the organization can break into whenever it needs to. But as I'm sure most of you are aware, an endowment fund can be difficult to undo outside of a specific set of circumstances. So let's talk about that in more detail. So first, what do we mean by seeking a release or modification of restrictions on a permanent or term endowment? Well, we obviously are not allowed to release the funds from the restriction that it be used for the charitable purposes of the organization. That's a permanent restriction. But outside of that, an organization could seek a modification or release of just about any other restriction, whether it pertains to the management, investment, or purposes of the fund, including any time restriction on the use of the funds. And, why would an organization want to seek a release or modification? Well, there's a number of reasons, and you may have your own story for your organization if you've gone through this, but some of the common reasons are that perhaps the purpose of an endowment fund is no longer feasible to achieve. Perhaps the program that the endowment fund was established to support is no longer in existence, or perhaps the cost of maintaining the endowment is just exceeding the benefit that the organization is receiving from it. There's really a number of different reasons that could lead an organization to this point. And as we discuss, or as we go through these different methods that are on the slide, some of these methods will be available no matter what the reason for seeking release, while others are really only available in certain limited circumstances. So as you can see on the slide, there's 4 methods for obtaining a release or modification of a restriction on a permanent or term endowment. And I've got these in the order that I would recommend looking at these if your organization were seeking a release. So first, you'd want to look at, are there any release conditions in the endowment agreement itself that would allow your organization to unilaterally change the terms of the endowment fund? Second, you could seek the consent of the donor or donors to change the terms. Third, most states provide for the release of endowment fund restrictions if certain criteria are met, such as if it's a certain age and a certain size. And then lastly, you could seek a court order for the release or modification as a sort of last resort. So let's talk through each one of these options. So first, we're reviewing the endowment agreement. Hopefully you're catching on to the theme at this point that the first place to look when we have questions about the terms that apply to an endowment fund is the endowment agreement. You want to make sure your organization has all of its endowment agreements in an accessible place and that you're reviewing them on a semi-regular basis. And we want to look specifically here at what are the conditions of release or modification, if any, that are included. If you had a really good lawyer draft this for you, you may get lucky and have a broad set of release conditions related to various potential scenarios. And this is one of the things to keep in mind if your organization is currently considering or in the process of creating an endowment fund. It can be extremely valuable to take the time to think through possible future scenarios and discuss how the donor would want the fund to be handled in each of those situations. And then we want to document that donor's intent in the agreement, because it may be that the donor would release the conditions of the endowment in many situations, but if it's not in the endowment agreement, we're going to have to go back to that donor later to get their consent. If the organization doesn't think it meets any release conditions in the endowment agreement, then the next option is to try and obtain the written consent of the donor. And of course, of all the methods we're discussing, this is the one that doesn't legally depend on the reasons for seeking modification or release. A donor could release the restrictions for any reason at all if the organization can, convince them to do so. Now, obtaining consent is generally more practical when the endowment was created more recently and there's a smaller number of donors. It can be quite challenging if there's a large number of donors, or if this endowment fund has existed for a very long time. It can be hard to track down the donors and obtain their consent. Nonetheless, this can be effective, and I've seen it be effective for organizations. And so it's something at least worth looking into. Now, important thing to note, the organization needs to obtain this consent in writing. So a verbal release in this situation is not going to be effective in changing the terms of the original written endowment agreement. If the conditions in the endowment agreement don't apply, and you can't obtain a release or modification from the donor, then the next step is going to be to review the other statutory conditions in your state for release or modification. So for example, a MIFA provides this provision that you see on the slide that allows for release or modification of a restriction on small, older funds that cannot serve their intended purpose as long as the criteria on this slide is met. So first, there needs to be a determination that a restriction is unlawful, impracticable, impossible to achieve, or wasteful. Then the fund has to have a total value of less than $25,000. More than 20 years have to have elapsed since the fund was established. And then finally, you have to provide 60 days notice to the Attorney General or the equivalent official in your state with authority over charities. And of course, the funds still have to be used, as we said, in a manner that's consistent with the charitable purposes expressed in the gift instrument that are unrelated to the restriction that we are trying to modify or release. Now note that some of this criteria is listed in brackets. So this is to indicate that these amounts will vary by state. For example, I've seen states that raise the monetary value up as high as $250,000. And I've seen the year requirement lowered as far as 10 years. But these amounts listed in the slide are what were recommended to the states for adoption as part of the uniform law and are probably the most commonly adopted by the 49 states in DC. Now, of course, the Attorney General may object once they receive notice to this modification, or they could request additional information. So it's very important that organizations create a thorough document that explains the grounds it's relying on to meet these criteria. Although I will say, I think the interest Attorney Generals take in these matters varies widely. Our group recently worked with an organization to send one of these notices to an Attorney General. And before we sent the notice, we called the Attorney General's office to see if they had any specific instructions on the content of the notice, or if there was a particular person we needed to send the notice to. And we were surprised to learn that they were not, we couldn't find anyone who was aware of the statute or that had any, or they didn't know that they had a role to play in this process. And I think, that state is probably the exception. I know there are certain state attorney generals, especially, one example would be California, who have a large staff and are probably more on top of these matters. So, I think it's still very important to not assume that the Attorney General will not look very closely at your notice and the reasons that you give them for meeting these criteria. Of course, there's many endowment funds in existence that are too large or too young to meet these statutory criteria we just talked about, which leads to our last method of obtaining release or modification, which is seeking a court order. This one obviously can take some more time than the other three methods that I mentioned, and can also be more costly. So that's why this is a last resort. And so under a MIFA, a court's going to examine whether a particular charitable purpose or restriction on the use of an institutional fund has become unlawful, impracticable, impossible to achieve, or wasteful. And the exact meaning of those terms is going to differ from state to state. MIFA, unfortunately, didn't provide us any guidance on what they think those terms mean. They want us to rely on state law. So again, this is where getting an attorney involved will be helpful. So those are the options for obtaining a modification or removal of restrictions on a permanent endowment or term endowment. Again, I recommend organizations first look to see if they can access more funds under their spending policy by modifying their spending policy. But there are absolutely circumstances where it makes sense for organizations to seek a modification or removal under the 4 methods that we discussed. And I just want to mention quickly, because I think I'm a little over time, that having a well thought out endowment policy can be a great step to avoid situations where you need to seek a modification. An endowment policy gives the board essentially space to think about, does it make sense for our organization to accept permanent endowments? Some organizations have said it just doesn't make sense for us to do this. They may use board designated endowments instead, but I think it's important that before a donor comes to you and says, hey, I'd like to create a permanent endowment for with your organization being the beneficiary, that the board has thought through whether that makes sense or not, because it's hard to say no to money in that moment. So with that, I will end my presentation on endowments, and I'm now going to hand it over to my colleague in the office right next door to talk about some crucial employment law updates for your organization.
Yeah, thank you, Taylor. Pleasure to talk to you all. I'm glad you guys are here. Think of this as just a quick snapshot, almost a parenthetical, because I do see a lot of great questions coming in on endowments for Taylor. So I want to make sure we leave time for that. But going back to something Chris said earlier, employment and that side of things can become very expensive and one of the biggest spends, and there's the temptation to backfill and draw from endowments and other funding sources just to cover that. And so, it's relevant to this discussion overall that we're going into the employment side of things really carefully and thoughtfully. I mean, not only the sort of legal things that drive up the costs there, but also staff creep generally can get very expensive. So I think one of the best strategies is to stay on top of this developing area of law. I mean, as a field, employment law changes rapidly compared to tax law. I mean, Taylor's talking about statutes that have changed sort of once since the 70s, right? But in the employment context, things change every month. And especially if you're a larger nonprofit with a sort of multi-state presence, and Taylor and I work with nonprofits that have operations in every single state. There's a lot going on and you need to track. And where you don't want to end up financially is facing a judgment, facing fines, facing back pay obligations with interest and penalties because you weren't mindful of some states' employment law. I want to try to talk about 4 areas really quickly in just the next couple minutes. I'm not going to hit all the details on the slides. I think we addressed that you can get those, and our contact information is in here too. So real quick, probably top of mind in the employment law area right now is the Department of Labor salary rule that was rolled out earlier in the year. Phase 1 already went into effect in July, and we're looking at phase 2 going into effect January 1. And so this is a rule about exemptions from overtime, the Fair Labor Standards Act. And Taylor, you can put on the rest of the bullet points here. The Fair Labor Standards Act, addresses federal minimum wage and overtime, right? But not everybody gets overtime. You can be exempt from overtime if you fall within an exemption. The most common one that we see is the exemption for executive, administrative, and professional employees, EAP. Sometimes it's called the white collar exemption. And to be exempt from overtime under that exemption, there are a couple things that have to happen. The most important one, arguably, is that the person has to have certain duties, executive duties like leadership, management, or administrative, right? They're handling things independently, exercising judgment, or they're a professional employee in some sense. But if they have the duties, that's not enough. They also have to be paid on a salary basis, and the salary has to be above a certain threshold. This rule only impacts the threshold for that. And so whereas at the beginning of 2024, that was around $36,000, it's jumped up to $44,000 now. And on January 1, if the rule goes, phase 2 into effect, it'll be 58 and change. That's a huge jump. That's a big deal. And so how should we think about that? Well, first, let me talk about a few things you need to remember on the next slide here. That this is not setting a minimum salary requirement. Okay, you can still pay people less, assuming phase 2 goes into effect, or even the 44,000 that's in effect right now. You can pay people a salary less than that amount. They're just not going to be exempt from overtime. Okay, so then if they work more than 40 hours in a week, you got to calculate overtime based on the salary they are paid. Of course, the salary does need to meet federal minimum wage requirements. Keep in mind, there are state minimum wage laws equivalent sort of in concept to the Federal Fair Labor Standards Act. Some of those states have even higher salary thresholds for the white collar exemptions, notably California, Washington, a few others. So this is an area where the federal law doesn't displace higher, state laws with higher requirements. If you Google this, you might see, oh, there's an exemption for nonprofits if you're operating on less than $500,000 a year in revenue, and it doesn't count charitable contributions. So many nonprofits might look at that and say, yeah, we have less than 500,000 in revenue, excluding charitable contributions. Well, don't think you're exempt from this rule because there's individual employee coverage, and it's basically going to apply to any employee who is engaged in interstate commerce. And these days, that's basically anybody who's ever read an email. Okay, so no exemption really for nonprofits. You can't just prorate these new amounts for part-time employees. I can't get into why, but don't prorate for, now again, part-time employees can be paid a salary. It can be less than that. They're probably not going to work overtime anyway. That's the other part-time, but just keep in mind, they're not going to be exempt from overtime. I do want to say there's active litigation about this rule. There was a hearing in a district court in Texas on Friday. If I was placing bets, but I'm not, I would say it's probably actually not going to go into effect. If it does go into effect, I mean, a lot of the folks in our space are predicting the Trump administration would rescind it anyway. So that leads to some recommendations here. And in terms of recommendations, I think one thing to keep in mind is you got to plan for this. It could go into effect, but you might delay the implementation at least until toward the end of 2024 to see if this actually gets blocked by the court and so forth. I have on here a duties audit. Like I said, the duties test is a really big deal. I do find a lot of nonprofits aren't even aware of the duties test. So that needs to be on your radar, because even if the rule doesn't go into effect, if you've got people and you're thinking, oh, I'm fine because I'm paying them $48,000 a year, but they don't actually meet the duties test, you've got a misclassification issue. Overtime policies, I mean, if this goes into effect, but even if it doesn't, those are really important. A lot of people aren't paying attention to their overtime policies. You need to review those. If you do have to transition employees to non-exempt status, that's going to raise things about morale, tracking time, working on your phone in the evening, looking like some employees with the same job are working more because they're tracking their time differently. All these things, you need to work through that really carefully. We can certainly help. That's the salary rule. Real quick, a couple other things. Misclassification. We're going to kind of just skip over this, but I do want to highlight the point that I think a lot of nonprofits, especially on the smaller side, but not just the smaller side, there's a temptation here, like we just said, having employees is really expensive. It's getting more expensive all the time. So can we just have more people that are contractors, 1099 contractors? A lot going on here on the state level, on the federal level. You need to be real careful about this. Let me skip ahead, Taylor, to the slide on this for the Department of Labor, because there is a new rule that went into effect this year on the Department of Labor. I think it's 2 more slides, Taylor. These are various factors. You can look at these. These are the new factors. Let me just highlight. It's the second to last bullet point there. Extent to which the work performed is an integral part of the potential employer's business, right? If you have a contractor who is doing stuff that's integral to your business, to your nonprofit, like you couldn't exist without them doing it. It's not like they're just designing websites for you. They're doing like core functions. they should almost never be independent contractors, and there's significant risk because it's not just those employees that could come bring a claim, the government could do an audit, investigate, and so forth. Other things that should be on your radar, the Pregnant Workers Fairness Act. Just want to highlight this. EEOC rule went into effect with this. It's not a totally new concept, but everybody should be looking at your policies for accommodating and helping workers who are pregnant, who are new mothers, those sorts of things, because the standards and requirements here have ramped up this year. And very lastly, state leave laws. And this is where a lot of the cost is right now. And because more and more of you all are probably having remote workers working in different states, maybe even around the world, which is a whole nother thing, you're triggering, those employees are going to be almost always covered by the laws of the states in which they are working for you. And those states might have something different than where your main office is or whatever, and you need to be mindful of that and making sure they're getting the benefits that their state law requires. And in particular, that would be time off. So a lot more states having paid sick leave laws. We made this slide before the election. This was a ballot initiative in a number of states. So it went from 15, it's going to be up to 18 now because Missouri, Nebraska, and Alaska all added these on the ballot last week. And they're not into effect yet, but they will be. And then paid family and medical leave. That's a huge trend right now across states. Usually these are set up as like state insurance type programs. Premiums are deducted from paychecks and so forth to fund these programs that then provide state benefits to employees. You need to make sure you're on top of those, paying into those. Sometimes you can do a private plan or an internal plan or whatever. But these are all areas that, every couple months you need to be getting updates on this stuff and make sure you're in compliance. Again, as costly as it is to comply, it's going to be less costly to be ahead of the curve than to be caught with a claim or something like that down the road because you weren't paying attention to what's going on. So that was real quick. I want to make sure we have time for Taylor to address some of these endowment questions, but thanks again for joining us.
That was wonderful. Thank you, guys. There are quite a few questions, so I was just reviewing them, and I won't be able to get to all of them, but John and Taylor can reach out to those who we do not answer after the webinar today. Easy one, can a donor's estate provide consent?
Yeah, thank you. Good questions, Sarah. And thank you for all the questions. So I think it's going to depend on the particular state and the MIFA statute that's been adopted by that state. And so it's not actually such an easy question, unfortunately. There's not a universal answer. There could be states that allow it, but it's not universal, unfortunately.
Who may enforce an endowment spending limits? Does the government, federal, or state enforce these?
Yeah, so if we're talking about a permanent endowment or a term endowment, first, the donor is going to have a contractual right under the endowment agreement to enforce whatever the terms of the endowment agreement, addressing the spending policy are. And so the donor themselves could try to enforce those terms. And then, as I mentioned, the state attorney general could also step in to enforce the provisions of a MIFA in that state as well. So two sources could enforce the spending provisions.
Is the fee that organizations charge, usually 1% or so, that goes to the organization's budget, considered part of the endowment payout / spending?
Yeah, so this is something that hopefully is addressed in the endowment agreement itself. I think oftentimes endowment agreements will include that fee as part of the spending, but it doesn't have to. A donor could decide that they want that to be considered separate. I don't think a MIFA addresses that specifically. So I'm not sure under state law, but hopefully it's addressed in the agreement with the donor.
When a board has created a board designated endowment, is it common for those same funds to also be considered a reserve or a rainy day fund? Or do they usually keep those as separate buckets of money?
Well, I think you see quite a bit of variety. That's one of the advantages of a board designated endowment, is that there is a lot of discretion for the organization to design the terms of the endowment fund to be specific to what the organization needs. I certainly think some organizations treat it as a rainy day fund, saying we're going to set aside these funds for the long term in case we need them, and not consider them to be expendable as part of our current annual budget. But other organizations set them up for other reasons as well. So you see a variety, and that's, again, one of the advantages of board designated endowments is you can meet the needs of your specific organization.
Oh, I have not heard of this. I've heard of a MIFA because we talk about it a lot here at Innovest, but the question is, our auditing firm utilizes SP MIFA instead of a MIFA in the notes to financial statements regarding the endowment. What would be their reason for doing that? And should we ask for a change to a MIFA?
Well, MIFA is the name of the uniform statute. Some states do modify the name of the statute slightly, and don't call it up MIFA. Most states call it up MIFA, but not all. So my guess there is that that's the name perhaps of the statute that's been adopted by the particular state that's laws apply to your endowment.
You're rolling through these. This is great. It's allowing us to answer more. Our
Okay.
organization has one main endowment fund. Do we need to have an endowment agreement with each endowment donor if our organization's bylaws state the endowment is a quote qualified endowment as permanent irrevocable fund?
Interesting. It's in the bylaws. Okay. That may be a question that's going to be specific to that organization, and we'd have to look at the particular provision in the bylaws to see what type of endowment that is that's being created. I'm not sure I have enough information to provide a whole lot of guidance there. Generally, yes, you want to have an agreement with each donor. And that can take different forms. And I actually didn't mention this, but MIFA says that actually marketing materials can qualify as essentially a donor agreement for a permanent endowment. So it doesn't necessarily need to look like a traditional endowment. The important thing is that the terms are written down and provided to the donor, and that there's some evidence that the donor has agreed to these terms, including providing money to the endowment with complete knowledge of the terms of the endowment.
I'm going to switch gears here and have a couple questions for John. Can you tell us more about part-time employees and how that should be handled?
And I'm assuming this is about the Department of Labor salary rule. So part-time employees are almost never going to be exempt because they're rarely going to be paid a sufficient enough salary. It could be if you have really high level part-time employee. So in the vast majority of cases, you're going to pay part-time employees on an hourly basis, meet the applicable minimum wage requirement in the state where you are, if there is one, above the federal minimum wage. That also means they're going to be entitled, we didn't talk about this, but meal breaks and rest breaks, which are features of state law in a lot of places. You can, this is a point, where there's a lot of confusion. You can pay part-time workers on a salary basis. They're just still not going to be exempt. So they should still track their time in the unlikely event there's some big thing going on at, on campus or whatever. And so you've got all hands on deck and they actually end up working more than 40 hours. Or, if the state might trigger, if it's more than 8 hours in a day or 12 hours in a day or that sort of thing, they would get overtime, and that's calculated based on whatever that salary rate is divided by 40 and so forth.
Great. We are out of time for questions because we need to roll into the next presentation, but thank you so much, Taylor and John, for your expertise on endowments and employment laws.
Thank you.
Grace, you bet. If you guys want to stop sharing your screen. And Sarah and Mike, if you guys would like to start sharing your screen, great. All right, let me introduce the next presenters. This will be the final presentation that we have. And then before we sign off, we do have Ide Bailey coming back on to tell us how we will obtain the CPE credits and get the presentations to you all. So Ide Bailey, I'm sorry, I already introduced you guys to Ide Bailey. Let's introduce you to Sarah and to Mike. Their title of their presentation today is Auditing Investments and Endowments for Nonprofits, What You Need to Know. So Sarah Greiger is a senior manager based in the Omaha office who spends the majority of her years serving nonprofit clients. She loves that in her role as an auditor and advisor, she gets to play a small part in what each client is doing to make her community a better place to live. Sarah serves on the Ide Bailey's Technical Issues Committee for nonprofits, as well as several local nonprofit boards. And then Mike Hart. Mike is a senior manager based in the Denver office who splits his time between serving nonprofits and investment fund clients. He loves being able to train others about complex topics in a practical and usable manner. This includes working with our nonprofit clients to assist them with any unique issues or circumstances that may arise throughout the year. So with that, I'm going to turn it over to Sarah and Mike.
Thank you, Sarah. We're excited to talk to you today. Hopefully everyone's excited for kind of the last bit here. Keep you engaged this last hour. There will be some overlap with what we talk about, especially when it comes to endowments, with what Taylor was talking about earlier, but we thought it's good to kind of reiterate that because I know endowments can be tricky for a lot of people and a lot of organizations. And kind of before we dive into this a little further, I will say in Nebraska, which is where I'm based out of, we use NUPMIFA, so NUPMIFA. So that is a very common thing to see, that you might have an UPMIFA standard with a slightly different name. So that's just my experience, is almost usually NUPMIFA. So anyway, we will kind of jump into things here. This is our agenda of kind of what we're going to go over. Some background on investments and endowments, and then talk a little bit more about kind of what we do as your auditors so that you know what you're going to need to prepare for, what to be ready for, what your auditors are looking for when they're coming in at the end of the year. We'll talk a little bit more on alternatives and kind of how to account for them, and again, how we're auditing them, and then leave some time at the end for questions as well. So I'm going to jump one more slide. So I'm just going to talk a little bit about sort of the basics of introductions on investments. So nonprofits typically hold a variety of different kinds of investments. Some of those are investments that you are purchasing yourself as the organization to invest, and some are contributions of stock that you have received and chosen not to cash out, either because that's your choice or because that's the donor's requirement. It's usually a combination of short and long-term financial instruments, often long-term more than short, just to kind of depending on your cash flow needs. Typically, you'll have an investment policy adopted by the board, and that's extremely important to have, as well as if you have an endowment, it's best practice to have an endowment policy as well, setting out what you're going to be taking out of it every year. But your investment policy is really going to talk about what are we hoping to achieve from our investments? What is our risk tolerance? How moderate, how conservative, how aggressive do we want to be? What are we hoping to get back in earnings every year? How much percentage do we want in equity versus bonds, et cetera? And so really laying that out so that then the board of directors has kind of a guide map to use, and management has that to use as well. And then you can use that when you're talking with your investment advisors. Another thing we see sometimes are gift acceptance policies. That's becoming more and more popular, especially with the introduction of crypto. What will you accept? How will you accept it? We're starting to see more and more organizations creating a policy like that, just to determine if you want to accept those types of gifts, and if so, kind of what you're planning to do regarding them. So these next few slides, we're just going to talk about the categories of investments. Again, the big ones you'll typically see: equity and debt securities, investments under the equity method. This can be partnerships, limited liabilities, derivative instruments, and kind of that other category, real estate mortgage notes. We'll talk a little bit more about some of those more unusual items a little bit later when we talk about alternatives. So as a reminder on how those are valued, if you're purchasing it, it's acquisition cost, whatever you paid for it, that is the cost basis. If you're receiving a security as a contribution, it's based on the fair value at the date the gift is received. Next slide there. So then investments in your debt and equity security is kind of your typical, this is your common stock, your mutual funds, your corporate bonds, your treasury bonds. These are reported at fair value in the statement of financial position. And so changes in that are gains and losses that flows through your statement of activities. Investment income is going to include your unrealized and your realized gains and losses, as well as interest, dividends, and investment fees are now shown net with that investment income on your financial statement. So it's no longer showing in expenses, it's showing netted against the income. It doesn't flow through functional expenses anymore either. When the use is limited by the donors, so oftentimes when we're talking about our endowments, they give certain money and that money is restricted. That income is also restricted. So it's not uncommon to see on your statement of activities that you would have without restrictions income and with restrictions income, and get to see that split out there, because obviously if the corpus is restricted, that income on it would also be restricted. And again, that is depending how it is restricted and when it is released depends on the donor. Oftentimes the donor will say, I'm going to give you money for the endowment and you can use so much of it every year, or you can use it in accordance with your endowment policy. Others will be very specific, saying you can only take this out for scholarships or for capital purchases. And so that depends on your releases will be based on the donor's requirements there. Next slide. Perfect. So this kind of talks a little bit about the levels a little bit more. And I'm going to actually turn this over to Mike.
Thanks, Sarah. So when we're talking about valuing the investments at your organization's year end, we look at it through the framework of FASB, ASC 820. That's our nerdy accounting guidance there. But essentially, that guidance directs how an investment gets valued at a specific point in time, and we look at it through three kind of levels. We call it the fair value leveling. But essentially, there's level 1, 2, and 3, because we're very creative here in the accounting world. But a level 1 investment is essentially, it's something that has an active market. It's being traded. It has a quoted price, usually on a daily basis. Not always. There are examples where it's maybe not quoted on a daily basis, but that's your most typical example. These, they're investments that are being traded consistently. They're being traded often, that you can kind of gauge where the market is. And so these are going to be your stocks in companies. These are going to be mutual funds. These are going to be exchange traded funds. We get into a little bit of crypto, even things like Bitcoin. There's active markets out there for it. So there is kind of that, there is that active market there that we can observe. So those are usually the easiest to value. You're going to see those on an investment statement coming in from either your advisor or whoever your custodian is of your investments. Where things start getting a little bit trickier is when we start talking about level 2 and 3. So a level 2 investment these are inputs that have a quoted price, but they may not be in an active market, or they're in it's the asset that you're holding. It's not exactly what's being traded on that active market, but it's similar. So think along the lines of in these cases, this is going to be a corporate bond or a note. We even have here mortgage-backed securities, preferred stock. There's really a lot of examples of level 2. Even certificates of deposit can get into level 2. There's really a lot of, it's kind of a catch-all for saying this doesn't have an active market, but it's not completely unobservable. There is somewhere we can point to that has a value. And usually again, if you're using an investment advisor or you're using a reputable like a Charles Schwab, someone like that, they're going to be able to point to what a price is at year end. They usually have some sort of of software that they can kind of verify what that price is. But again, it's not on an active market. So level 2 is kind of the in between. So then when we talk about level 3, these are strictly unobservable inputs. So there is not an active market for this asset. This can be a variety of things of what make up a level 3 investment. We see ownership interests in LLCs or partnerships. Obviously, those are not actively traded. There are times if you're a nonprofit, real estate, if you're making a fair value option election, that can be classified as a level 3 investment. We even note here investment funds that don't qualify to be reported at net asset value. That also can be, those can be level 3 assets, but we're going to talk a little more about net asset value later. But essentially what it comes down to is if it's an unobservable input, or unobservable market, how do you value these assets? Usually that's going to come down to some form of discounted cash flow calculation, or there are instances where you see, let's say it's an ownership interest in an LLC or a partnership that maybe someone else just sold off a portion of their partnership, someone else who's an owner in that partnership. You can make, if you have access to that information, you can then maybe mark up or mark down your ownership interest based on what that transaction sold for. But again, there's really not an active market that you're going to be able to point to for that. So the level 3 kind of has a lot of, there's a lot of different techniques that you'll see involved with a level 3 investment. But they do form around some type of cash flow or or potentially other similar transaction that's happened. Yeah. So I'll kick it back to Sarah to talk about crypto a little bit.
Perfect, thank you. So crypto is kind of becoming a hot topic, especially in the nonprofit world, as people are kind of interested in donating that now. And so going back to that gift policy, this is where it's a good idea to know whether or not your organization is going to choose to accept cryptocurrency. And you can choose one way or the other. A lot of organizations are still pretty hesitant to accept crypto just because there's still a lot of unknowns, but we are starting to see it more and more. So I think it's a good idea to start thinking about it as an organization and what you want to do. With that, there's a new standard coming out on how to account for crypto, and this is going to be effective for fiscal years beginning after 12/15/2024, so kind of coming up within the next year. So you are allowed to early adopt this, but just some additional guidance and some more clear information on how you should be recognizing your crypto assets if you have them or are going to start accepting them. I'm going to go to the next slide, please. So really what it gets down to is it's providing better guidance on how to account for it. So talking about how to measure it in the first place. It used to be historical cost impairment model. Now they're saying fair value measurement for measuring the asset initially. And then as far as presentation goes, kind of simplifying that, showing gains and losses and net income, much more similar to how you would show gains and losses on investments. If it's converted to cash nearly immediately, you don't have to break it out on your statement of cash flows. So if you think about on your statement of cash flows, when you have purchases and sales of investments, you have to break all that out down below in your investing section. Whereas if you have received a crypto gift and you receive it, but you don't keep it in crypto, you immediately convert it to cash. You don't have to break that out in your statement of cash flows. You can just include that in operating cash flows. So that simplifies the process a little bit. There's some more specific disclosure guidance, which will help showing kind of what you're holding, any restrictions on it, showing roll forwards, and then also detailing those gains and losses. I think that's about it on crypto. We're just touching high level on that because I know it's something that is still very new to a lot of organizations. We do want you to be aware of that, especially if you are considering taking on some crypto assets in the future. So I'm going to turn it back to Mike to talk a little bit more about endowments.
So we already heard Taylor's great presentation regarding endowments, talking more on the legal side. So we're gonna touch on the accounting. There is a little bit of some kind of rehash of some things that were already discussed. But an endowment, at its basic level, is an established fund of cash, securities, or other assets to provide income for the maintenance of a nonprofit. So very nice, tidy definition of it. But what then happens after that is going to be, you know, how you record it, how it gets allocated is going to depend on, you know, also if the donors place any restrictions. MIFA is going to come into this. Are there any board designated endowments that you have, or the quasi endowments that were discussed? And so when it comes to an endowment, you know, you're receiving the gift. Let's say you're receiving the $1 million gift that the donor says, hey, the $1 million is restricted for into perpetuity, but the earnings can be used for, let's say, it's education. So how then do you go about spending those earnings, right? It's not just a simple, well, I made 10% this year on those endowment funds, so I'm going to spend all 10%. There is usually then going to be a spending policy that's established with it. So that spending policy sometimes can be established by the donor. The donor may have a specific requirement saying that earnings, you know, it must be 5% of earnings spent every year, something along those lines. That's, you know, that's obviously the first and foremost what you have to follow. But if there's not a set spending policy established by the donor, then usually your board of directors are going to be the ones that are establishing that. And there's many examples of what those spending policies look like. I couldn't even begin to prescribe a set one of what those spending policies are. I'd say maybe a typical example is up to 4% based on a rolling 12-quarter average, right? There might be something along those lines where they're the board is establishing where they're maintaining the spending power of the endowment, but also making sure that they're supporting, the organization is being supported via that endowment. So we're going to get into an example of this a little bit later. Sarah's going to walk through one, but where endowments from an accounting perspective get a little tricky is when funds start getting commingled. So usually what'll happen is an organization is receiving maybe 10 different endowment gifts, 50, 100 different endowment gifts that, some might be established, like I said, for education, some might be for general operations, whatever they may be. And the organization, instead of opening up investment accounts for each and every one of those endowment funds, they commingle them, which makes sense. It's a lot easier to manage from an investment standpoint. However, what that does create then is there has to be some math done then to determine how to allocate the earnings, right? So you're allocating your earnings, you're allocating your spending rate policy accordingly based on the kind of the prorated volume or prorated value, I should say, of whatever's in your endowment. And so there's an example that we're going to walk through a little later that'll make that clear. But allocation is a big deal when it comes to endowments from an accounting perspective. And then, of course, underwater endowments were touched on, and kind of the new standards that come with MIFA as a result of that. You are able to spend from endowment funds that have gone underwater. But we do typically on our end, when as an auditor, we're assessing those underwater endowments, and we're going to just make sure those are disclosed accordingly, letting the readers of the financial statements know if any endowment has gone underwater. So we did talk about, again, too, just with endowments, we're gonna see basically, is it a board designated endowment? Is it a donor restricted endowment? The example I gave earlier, the $1 million, that's a donor restricted endowment. There are going to be instances then when you're going to see board designated endowments. This is the board saying, hey, we want to endow funds for the use of the organization, kind of maintain, again, spending power, long-term sustainability, whatnot, but those funds do not have a specific donor restriction attached to them. So there may be, the board may say these are subject to the exact same spending policy as we've established on the donor restricted funds. That's totally fine. There may also be instances where you're tapping into those. But the goal of a board designated endowment really is that you're kind of commingling it with your donor restricted endowments, but there's still delineation that's made. And again, when we get into accounting and the examples of what happens, we're still wanting to make sure those are broken out accordingly, because we want to make sure that you're disclosing your board designated endowment and you're disclosing your donor restricted endowments accordingly. So there's an area here with additional considerations. There's a chart here on this next slide that kind of gets into this a little bit, kind of showing that endowments, endowment can encapsulate both board designated and donor restricted. Donor restricted is more narrow, a little more narrow in scope there. And then there are some considerations. We're not going to get too far into it in terms of if you have money, if you've placed endowment funds with a community foundation and you've granted them variance power, in association with that, anything related to donor advised funds, there's some quirks and some interesting things there that don't want to get too far into. But if there are questions, if anyone has questions, either after the presentation, during the Q&A, or wants to email, they have a unique circumstance they want to talk through. Happy to discuss that. So. All right. So with that, we're going to next talk about what our approach is for auditing. Why do we ask you the annoying questions that we do as your auditors? And so Sarah is going to start us off with that.
Perfect. So yeah, Mike hit the nail on the head there. You're getting ready for your audit. Mike and I are coming out, going, what are they going to need? What are they looking at? So we want to just kind of give you a high level of the things that are important to us as auditors and the things that we look at so that you can be prepared, but also so you can notice those kinds of risks yourself and look at those things yourself as you're going throughout the year. So the typical risks and estimates, so significant estimates would be anything that has a amount of management bias involved in it. So anytime there are those significant estimates or sensitive estimates in financials, we as your auditors are looking at that more closely. Think allowance for discounts, net present value discounts, functional expenses, those kinds of things are things that we're going to look at just a little bit more closely to make sure that your management's estimation process is appropriate. So these are kind of the risks and estimates we look at. Valuation of level 3 investments are really, level 3 is the only big one that we are too terribly concerned about. Level 1 and level 2 are pretty easy to estimate on the market. There's not a lot of uncertainty there, but level 3, and then also those investments not measured at fair value, so that NAV, your alternatives, your beneficial interest, those things, there's just a little more estimation in that. So there's a little more risk there. And then the other thing that we look at is when there's that allocation of earnings. So Mike had alluded to that a little earlier about how oftentimes you commingle all your investments in one fund, and that includes your endowment, that includes your board designated endowment, your donor restricted funds. And so then you're having to allocate earnings. We have this fund that's $100,000 of corpus, but it's 50,000 this, 50,000 that. And you have to split those earnings between those different categories. So there's some allocation there, making sure that that is done correctly. So those are kind of our big ticket items. And then when we get into our procedures over investments, we might do some testing over existence and valuation to make sure that the numbers you're reporting at year end are appropriate. And we do this a number of different ways. It's going to depend on the client. It's going to depend on your auditor. It's going to depend on a number of factors, but these are kind of the 3 big ones that at least we at iBailey typically see. So that would be scoping, and that's where we're going to say, we're going to look at all investments over a certain dollar amount. So we're going to look at every security over a certain dollar threshold. Sampling is where we're going to say, here's a list of every security, and based on risk and based on other procedures we're doing, we've determined we're going to sample X number. And we're going to use some sort of random selection or haphazard selection to just pick any random number of investments. So not necessarily the large dollar, not necessarily the small dollar, kind of just a wide variety. And then there, of course, are other methods where maybe we'll test all of the largest until we get your untested balance below a certain threshold. So there's any number of things that we're looking at there when we're doing that test of existence. The other big thing that we look at is the earnings. And so this is something that we look at for reasonableness. It's really important to us to make sure that the earnings that you're recognizing are reasonable in accordance with the market, in accordance with what you're invested in. Obviously, throughout the year, as management, you're going to be booking your entries to match your statements that you're getting every month, not necessarily digging into, is that reasonable? Is that acceptable? You might have an investment advisor who's coming out a couple times a year and giving you an update on the status of the market and how your investments are performing, but you also may not be getting that depending on the structure of your organization and your agreements with your advisors. So we like to look at that to make sure things look reasonable. And then I also like to make sure if I'm seeing a pattern where you're constantly underperforming, I'm making sure that you're getting that information. If we're saying, hey, the market is up here and you're always below it, but then when the market's down here, your loss is also worse. That's where we start to worry about that correlation. If you're more conservative, you should do better when the market is bad. And if those things aren't happening, we like to make sure we let you know that way you're aware, because we know this is not your top priority, top of mind issue for you and your nonprofit. So here's kind of a little bit over how we look at that. Sometimes it's as simple as tying out the results. We'll also sometimes be looking then at, okay, you received this much in gains. This is what you're invested in. We kind of set up an expectation of the rate that you should be getting, and are you getting it? Is it in line? And then again, we're looking at your year-to-date activities. So that roll forward that you're preparing for us, what are you recording as realized and unrealized gains and losses? And can we reconcile that to statements? And either you are a year end, just tying it directly to the year to date. If you're not a calendar year end, you're a fiscal year end, we might be getting a mid-year statement and an end of fiscal or an end of calendar year statement and kind of backing into that number. So those are kind of the big things we're looking at there. Can we go to the next slide? So then when we're talking specifically about endowments, our big thing is coming down to allocation of those investments. So making sure that the income is allocated based on the corpus, that each piece is appropriate. Also that if you're having distributions, that those are in accordance with your own policies, in accordance with any donor policies, and of course, making sure that we're not taking money out of perpetual investments. And also making sure that when you are going underwater, which can happen if your policy is allowing you to kind of keep right at that corpus level, and then the investment doesn't perform well, you can go underwater. Hopefully the investment will recover in another year or so and you get back above. So that's not a huge deal if you're slightly underwater. Where it becomes a problem is if you're consistently underwater and that's getting worse over time. And that's obviously going to be a concern for donors because they're giving you that money to be held in perpetuity. What's going on? So that's something that we'll look at. Again, we talked about that. The activity is reasonable against the market. Looking at your spending rate. So sometimes we will look at your distribution and recalculate what we think it would be. If you say 12-quarter rolling average, we'll kind of back into that number and see if it matches approximately with what you actually ended up pulling out. Again, just to make sure that you're following your policies. Those are kind of the big things we're looking at there. Mike, anything else you want to add on this one?
No, at this point, I probably a few things to add when we get on this next slide here, just kind of talking through the example, but not at this moment. Yeah.
Perfect. So this is a good example we put together for you, kind of just showing how you can track that. So ideally, you're tracking each endowment by the corpus, tracking what that is, and the accumulated earnings, or in some of those cases, losses, accumulated losses, any current year additions, any distributions, so that then at the end of the year, even if your investment statement is just the total value of all of those, you're able to break it down by each individual fund.
Yeah, and something with this spreadsheet usually is, I've seen this done many different ways. This can be, I mean, hundreds of rows depending on what your endowment looks like, what your endowment is composed of. And there are softwares out there that can track it, but I've seen a lot of people do this in Excel, and that's totally fine. But I would suggest if you're doing it in Excel, making sure to have 1 or 2 levels of review to just check, because the formulas in here can easily get kind of messed up, or numbers can get transposed, and so because of how pervasive then it could be, going throughout the entire spreadsheet, then you're kind of reflecting your endowment incorrectly. That's something that can definitely happen. So it's definitely susceptible to error. So just be aware and be ready for the potential. Just be ready and prepared for the potential things that can happen with tracking the endowment.
Absolutely. And then also making sure that when you're taking distributions, that they are in accordance with the donor's original intent. So the donor is telling you, for example, in this case, giving money for the scholarship fund, you can take out distributions to give to students or whatever the organization's needs are, to give out in accordance with that, making sure that those dollars actually are getting spent that way and not just going into operations. Or if there are certain requirements on how much can be taken out. I have a client who a portion of the earnings every year is required to be added back to the corpus, and increasing the corpus to be held in perpetuity. So we have to kind of have a reclass there from their earnings into that perpetual fund. So just keeping in mind that there can be some differences in each donor and making sure that you are meeting the requirements set forth by your donor. All right. I think this next section is going to be talking alternative investments, which is Mike's bread and butter. So I'll turn that over to him.
Well, that's debatable, but no. So alternative investments is basically what it sounds like. It's an investment that's really outside of the normal type of securities, bonds, something that you would typically see. These are the ones that, we're going to differentiate between. Some of alternative investments are level 3. Those are, real estate is considered an alternative investment. Partnerships are considered an alternative investment. But kind of in our lingo, when we start talking alternative investments, we are usually talking about hedge funds. We're talking about some sort of fund, hedge fund, fund of fund, real estate fund. Anything that might be considered a fund is really what we're getting at. So if there are questions, again, during Q&A, whatever it may be, if there are questions over kind of valuation or approaching the alternative investments that are, a partnership interest, an LLC interest, something along those lines, please feel free to reach out. But we're going to specifically talk more along the funds. And so where funds, the specific accounting guidance that we reference, again, is in ASC 820, but it's really talking about net asset value. And you see here, there's mention of an NAV, net asset value, practical expedient. We'll touch on that here in just a second, but yeah, we're talking mostly about the funds. So when we're talking about hedge funds or real estate funds, whatever it may be, typically the organizations we're working with will be a very small investor in these funds. These funds can be billions of dollars, where maybe you as an organization have put in 500,000, $1 million. Usually you don't see below that, because with these funds, there's typically there's usually a threshold a minimum you have to invest. And so the organizations I see are typically putting in, maybe they put in only 200,000 up front, but then the fund has a requirement that says you have to, whenever there's a capital call for money, you have to invest up to $1 million. So then you may have put in $200,000, but then you have an unfunded commitment, as we look at it, of 800,000 to get to that $1 million. So when we talk about these funds, we're typically seeing these accounted for as net asset value. So previously I mentioned there's, levels 1, 2, and 3 in kind of the fair value hierarchy, or, table for valuing investments. Net asset value actually falls outside of that fair value hierarchy. But typically when we're disclosing these in the financial statements, we're disclosing anything that's at NAV. We're disclosing them in the same area. They're just not considered within level 1, 2, or 3 of the fair value table. And the reason for that is they actually used to be. This is a fairly recent change within the past decade or so. These funds used to be typically at either level 2 or 3 based on lockup provisions or the commitments or whatever they may be. But now there was a practical expedient that that FASB came out with that essentially said, okay, if you're in a fund that does not have a readily determinable fair value, and that fund reports under ASC 946, so that's our accounting standards codification, but really the main driver here is, are they an investment company? Is that what their sole goal, the fund is are they an investment company? Then what FASB allowed for is they basically said you can report them at net asset value, and all net asset value is essentially whatever your stake in the fund is, whatever you put in, plus any gains or losses, less distributions, anything like that, as reported, and fees as reported to you by the fund manager. So with these funds, what's usually happening is you're getting monthly, quarterly, sometimes I'll see semi-annual or annual, but usually it's either monthly or quarterly statements from the fund manager, who's saying, okay, here's your organization's specific ending net asset value in our fund. And that's usually then what what your organization is going to report them at year end, or at whatever the reporting period might be. So when we talk about alternative investments, we're going to talk a little bit too about auditing, and there's many examples we could look at for this, and we might have some time here for some examples at the end to show you what disclosure of these looks like. But when we're talking about auditing of these alternative investments in these funds, there's very similar risks that we're talking about, similar to a security, which is, does it exist, right? Do you actually have ownership of that security or of that stake? And so we're going to verify existence through either a confirmation or through a third-party statement. And again, those third-party statements are usually coming from the fund manager. We also, though, when assessing these funds, we're going to also be looking at, is it appropriately accounted for as net asset value? Is that approach appropriate? And that's going to be we're going to typically look at audited financial statements of the fund. Usually when you're in these funds, you're receiving the audited financial statements on an annual basis of the fund. We're also going to look at what's your ownership percentage, because we're going to want to try and recalculate what your value in the fund is. And that's usually just a function of what's the net asset value of the fund as a whole for the audited financial statements multiplied by your ownership percentage in the fund. And usually the fund manager is able to provide what that ownership percentage is. If they don't do that, typically you're also receiving a K1 from these funds, and there is an ownership percentage on there, although there might be slight differences from a tax basis versus kind of our GAAP accrual basis. And then we're also, as I mentioned, we're going to look at unfunded commitments. When we talk about unfunded commitments in the financial statements, these aren't shown as a liability because it's not guaranteed that you're going to be needing to fund these in the future, but we are disclosing that, hey, yeah, you've invested $200,000 in this fund, and here's the net asset value at year end. But you may, as an organization, also have to give an additional $800,000 at a moment's notice when those capital calls come in. So then with alternative investments, we're also going to look at the same thing as we look at with normal investment testing, which is we're going to want to see a roll forward of your activity during the year. We're also concerned here with testing the earnings, although testing of the earnings on these are a little different than testing the earnings of normal securities. We could tie out to the statements, but because a security has a nice market that can be pointed to, there is some concern with alternative investments that if the fund manager is providing either bad reporting or they've under or overvalued in their reporting before they provided audited financial statements, we're going to want to make sure that the values that they're giving to you, that the income that they're showing on during the year seems appropriate. And that's usually done by looking at some sort of benchmark. So we're going to compare, even though these aren't in an active market, there might be a comparable fund or a comparable level 1 security that kind of is akin to these these funds. So for example, let's say a fund you're in is actually pretty akin to the S&P 500. We might use the S&P 500 as a benchmark. If the S&P 500 showed a 7% return and the fund you're invested in showed a 6% return, okay, that's pretty comparable. But if you then show, a 15% return, then there might be questions there of whether the reporting you're receiving is accurate. And so we might have to do further procedures, but it's very similar to what we're doing with securities in terms of kind of of what we're trying to accomplish. Just the way we accomplish it might be slightly different. All right. We're going to talk one more thing on in terms of investments and what to do for financial reporting, and something that we typically see when it comes to the financial statements that often trips nonprofits or organizations up, and that is the cash flow statement. Everybody's favorite accounting statement. If you could choose a favorite accounting statement, if you want to do that at your next party, ask everybody what their favorite accounting statement is. It's always going to be the cash flow. But Sarah and I will kind of go back and forth here, but with investment activity and on the cash flow statement, the big thing here is that cash flows cannot be netted together. And that's really the biggest area that we see people get tripped up with. And what does that mean is essentially, if you are making, a lot of purchases and sales, if there's a lot of activity, even if it's just switching from, a one fund to the other, you sell one fund and then you purchase another, those cannot be netted together. That activity has to be presented gross on the statement of cash flows. And that's an area where we definitely see people get tripped up. And that does have to be reporting in the investing activity section. And then also, when talking about the realized and unrealized gains or losses, where that goes, I think another area that organizations will get tripped up with is they are, they think maybe that's part of the investing activity, but really the realized gains and losses, if you're reporting an indirect cash flow statement. So if you know the difference between an indirect and a direct cash flow statement, an indirect cash flow statement in the operating section, you are having to reconcile out those realized and unrealized gains or losses. I think we're going to have a minute here to show an example, and I think Sarah can show an example of what that looks like. It's much better than me trying to fumble through it with my words.
Yeah, do you want me just to switch to that now? You want?
That'd be great.
Okay, so I will share that. Okay, let me try again. Okay, you're seeing this now?
We are. Yep.
Perfect. So this is an example from what we call our Save Our Charities template, which is Eide Bailly's created template, but it's also what the AICPA has deemed as acceptable as a template for nonprofit standards. So we're just going to go through some of this here. So this is a statement of cash flows. And again, this is indirect method. This is what we typically see for our nonprofits. But looking at that here, this is where we're talking about purchases and sales of investments. You can't have netted that 7.5 and 7.9 together. You have to break that out. And then again, up here,
this is the direct method, it looks like, actually.
Oh, yep, you're right. This is the direct method. Here we go. Here's our indirect method. Up here is where we've got the change in realized and unrealized. And something to note here is this is specifically just realized and unrealized. So your interest income and your investment expenses, dividend income, all of that is going to be included in those purchases and sales, offsetting those purchases and sales. A couple other things to point out here. Your change in your beneficial interest valuation will be up here, whereas I'm going to kind of flip back and forth. Here, your additions and withdrawals to those beneficial interests are going to flow through investing. So if you take a distribution out of your beneficial interest, that will flow through investing. If you get money and add to it, that'll flow through investing. And then the valuation will flow through operations. The other item that we want to touch on, because this one can get tricky for people, is When you have contributions that are restricted for long-term purposes, those will need to be shown down here in financing. And when you're using the indirect method, you're going to be showing, let's see, do we have a good example? Here we go, contributions restricted to endowment. That's going to be the accrual value here, is the dollar value that you're actually recognizing this year is going to show being decreased from operations. And then the cash that you're physically receiving this year is going to be showing as financing. So collections of contributions restricted to endowment. So this is going to be cash basis down here. So if last year you got a pledge for 50,000 to the endowment and you received it this year and you got another 100,000 of revenue for the endowment, this number would be 150,000 because it's going to be the cash basis. And then this will also usually pretty cleanly reconcile to your endowment footnote. So it all works together. See, I like the statement of cash flows because I like how it all ties all throughout the file. So it's okay. Mike has judged me for that before. It's all right. Get over it.
I said it was everyone's favorite, right?
Yeah, but I felt a little sarcasm in that.
Yeah. So yeah, just be aware where this comes in is if you're running any sort of campaign, especially like an endowment campaign, that's where you're going to see the discrepancies between financing and operating.
Yep.
If you're just having a normal year where everything that was added to the endowment was just cash given as a contribution, though the difference between the operating and the restricted section and the financing section are probably not going to be, there's probably not going to be a difference there. But if you are running some sort of endowment campaign, you are going to see discrepancies because you're going to see a lot of pledges that are coming in or promises to give. So just be aware of that as you're looking at the statement of cash flows.
You want me to, since we've got a couple minutes before questions, you want me to jump down to the alternative, like the NAV pages here and show some?
Yeah, actually, let's go to I actually would like to go to the endowment footnote really quick.
Yeah.
Just to
see if I can
to illustrate
guess
that.
down correctly. Here we go.
So we talked a lot about endowment today, and this is probably one of the lengthier footnotes when preparing a nonprofit's financial statements. And so, we're really trying to indicate what's your, it's telling a story. What is your endowment for? Is it for a variety of purposes? What is it composed of? We're going to disclose the board designated portion. We're going to disclose the donor restricted portion. And when we talk about the donor restricted portion, it's, we're wanting to differentiate what is the corpus, what are the original gifts that you've received, and what are the accumulated investment gains, or in some cases losses associated with that donor restricted endowment. And so that's what this top table is kind of illustrating, kind of showing that breakout. Then below it is discussion of underwater endowments. And then we get into the spending policies, right? We're talking about what is the spending policy that's been adopted by the board usually, outside of any sort of spending policy that a donor has. Again, they've specifically said you have to spend in accordance with this. And then again, we're getting more information after the spending policy into discussing what's the activity that happened during the year, both within the board designated endowment and the donor restricted endowment. And so we're illustrating all of that activity in these tables here.
And just one thing, if you remember the number on the statement of cash flows we saw earlier, the financing number of contributions to the endowment, that matched this exactly. So again, that cash basis is what's going to tie out to your footnote.
Yep. So that's really, it's a, we typically see 2+ pages of footnotes related to the endowment because it's really trying to illustrate the whole story of what's occurring and what's the activity during the year for that endowment.
And one other thing to note on your underwater endowments here, if you look at this, you can see it'll say funds with an original gift of X, fair value of Y. This is where you're not just going to say in total we're underwater by $5,000. Or for example, if you look at this example, they aren't underwater in total, but we are recognizing that one or two of those funds is underwater, even though the net total is not. So you still have to disclose the total that every single fund is underwater. And you can combine those together. You can say there's 3 funds totaling X dollars underwater by Y dollars, but you do need to look at them at a fund to fund level, not in total.
Yeah, and that'll just happen from time to time if you receive a gift right before a market downturn, that can definitely happen. So
Yep.
just be aware of that. You may have a lot of gains in your endowment in total, but one endowment fund specifically might be underwater just because of the timing of when it was received.
And then Mike, do you want to share our presentation again, just to get our contact information on the screen?
Yes.
And then Sarah, I think we're ready for questions.
Great. There are a lot of them. Is that so
That's good. We explained it really well then, right?
Yeah.
I think the whole day has just been a wealth of information, from beginning with the state of the economy and then talking about the legal ramifications, and then you guys getting into alternatives and talking about, the accounting side of things. I think brings it all together, and it's extremely helpful for people. So getting on to questions, we have about 9 minutes before we wrap up, and I'll just kind of do rapid fire here. What is the best platform to accept crypto?
It's a great question. I don't know the answer, honestly. Most of my clients at this point are not accepting crypto. Ksenia, have you seen that? I saw your face just pop up, so I'm wondering if you've got some insight.
Yeah, no, that's good. Hello, everyone. I'm Ksenia Popke. I'm an audit partner with Ide Bailey in charge of our regional not-for-profit practice here. And so I did see a few questions, so I thought I'll pop in. We have a couple clients on Coinbase. I would say Coinbase is probably the most common platform right now in the not-for-profit world. I've heard that too at the ACPA conference that we just recently attended. So the Giving Block is probably another one that we see, but I would say for those not-for-profits that are actually holding crypto, Coinbase is what I typically see most often.
And welcome, Ksenia.
Thank you.
What is the best platform or I'm sorry, let me go to the next one. What software would you recommend for tracking?
For tracking crypto or for tracking endowments?
It doesn't expand on that. That's just the question. What software would you recommend for tracking? Let's go.
I think that might be, Mike, you were alluding a little bit to some softwares out there for tracking of endowments.
Yeah, I have to go specifically because I know there are most of my clients are probably through Excel, because it presents kind of the best, not the best way, but probably the cheapest way of doing it. If you're getting into hundreds and hundreds of endowment funds, that's one I can definitely look into and reach back out to the group with, or if that person wants to reach out to me independently, my contact information's up there, and I can definitely look into that. But yeah, there are definitely softwares out there, but Excel is probably the most common one I've seen.
For accounting and audits, if a quasi-endowment contains pooled donor gifts with all of the same donor intended purpose, i.e. scholarships, do they still need to be tracked individually for interest gains, even if donor agreements have language that it is a pooled fund?
I mean, ultimately, I think best practice is probably still to break it out, unless it's specific in the language of this is going to the scholarship endowment or something to that regard. Then I think you might be okay to put them all into that category. But if it's, donor A is giving $1 million for scholarships and donor B gives $1 million for scholarships, I would probably look at those separately. I'm guessing it's going to be more of a case-by-case basis. Mike, any?
No, I usually just see, it's just if you have some, especially when you're talking those large dollar amounts, especially if you see a named endowment, those are definitely being tracked separately as well. So if it's, if it's associated with someone, or they just named it for some reason, then yeah, you're going to be tracking those separately.
Recommendation for a maximum % of real estate in a university endowment fund. Comments on differences in undeveloped land, income producing real estate, planned future development issues can become a big job with the endowment. within the endowment?
I wish I knew the answer as an investment advisor to tell you the percentage on that, so.
I think I typically see most of my organizations, they're saying alternatives, which can include usually those real estate funds. Most of mine are saying 0 to 10%, 0 to 15%, somewhere around 5 is probably where they end up.
And I know I would add at Innovest, when we work with clients on creating their asset allocation, we also get to know what their downside risk is, what their risk tolerance.
Yes, absolutely.
Plays a big part into it as well.
Yep.
Agreed.
We've had some challenges identifying the cash and investments for our cash flow statement based upon the different naming conventions used by the various investment firms. Do you have any best practices to share for correctly identifying cash and investments?
Go for it, Sarah. You got that.
Okay. I would say, I look at anything that's called cash equivalents, money market funds. I'm kind of all considering that the same category there. If it's held in your investment account, though, if it's held in your investment fund, most of the time our financial statements that we're seeing have in their cash footnote saying that cash held in investments is not considered cash and cash equivalents for statement of cash flow purposes. So if it's in your investment statement, on your leveling table, you're going to be breaking it out as a cash and cash equivalents line or money market fund line or however you want to disclose it. But as far as your statement of cash flows, it should still be flowing through purchase and sales investments.
Yeah, and then not-for-profit can choose a policy for how they look
Correct.
at their cash held in the investment portfolio. I would say most of our clients, or at least something that we recommend for the reconciliation purposes and to make it fairly straightforward in the investment statements, the cash that's held within the investment portfolio is excluded from the definition of cash and cash equivalents for the statement of cash flow in the balance sheet.
Last question. Can the cash flow template be sent out so we can make sure our cash flow statements are properly set up?
So were you looking at you're probably talking about the Save Our Charities.
Save Our Charities.
Sarah showed, yeah. So that particular template of the financial statements is available through AICPA not-for-profit section. So I would probably go there first and then let us know if you still not able to gain it, because that particular template actually has the Excel for the cash flow statement on the AICPA section, so it might be easier even than looking at the PDF.
We actually got one more question while you were answering that, Ksenia. So this will be the last question. Many universities have a big Day of Giving campaign this quarter. Any guidance for best handling those gifts that range from $10 to hundreds of thousands of dollars?
I mean, I think if you're talking as far as tracking for purpose restrictions, I think the key is just making sure that whatever, most of those Day of Givings are being done online through a site, is making sure that the wording on that site is clear that, hey, if you don't specify a purpose, make sure there's obviously a place for them to specify a purpose, but if you don't specify a purpose, the gift is considered to be for operations, something to that effect, or the gift is considered to be for our scholarship fund, whatever it is you're trying to raise money for. I think just making sure the wording is clear so that if they don't put a purpose in, the default is clear of how their money is going to be spent. That answered the question.
Yeah, that's probably the biggest pitfall. Like here in Colorado, we have Colorado Gives Day, and it's always just making sure that whatever, whichever organization we're auditing, making sure that they're getting the proper reporting to if there are any restrictions attached with it, because that's really the biggest concern.